Good morning, friends. Okay, so today we're going to start with your derivatives part. Before I start, only one expectation that please don't think that this is a complex chapter. That is where I face challenge because students keep thinking that this is the difficult of the lot. I've tried all possible ways to teach it, but still the mindset is very clear that it is a difficult area. The reason is you speak to your seniors, they don't understand derivative, so they pass on saying that you will not understand derivative irrespective of what you do. It is as simple as time value of money. That is what this chapter is all about. When I do the initial futures part, I'm going to do same as what I did in time value of money at CA Inter. It is like portfolio where I had introduced three formats. Here also I'll introduce three or four formats. That is to take care of the futures part, three formats. Options part, maybe certain techniques I'll have to discuss it. And then I get into others which are newer areas which have come, like credit default swaps, exotic options, and credit collateralized debt obligation. These are new add-ons which are there. First thing we are going to do is valuation of futures. So before we start, we'll have to first understand what is this futures is all about. Without understanding futures, I cannot even go ahead and do. Like we have a spot market, we also have a futures market. You will have to understand that there are two markets in the practical world. There is a spot market called as cash market, and there's a futures market. In the spot market, you can do spot buy and sell. In the futures market, you can do future buy and sell. That is sitting today. You can make a purchase for 2024 December, or you can sell for 2024 December. That can be done in futures market. And today, if you want to buy and sell, you have to go to the spot market. So spot market can do you spot purchase and sell. Futures market can do you futures purchase and sell. So futures price versus spot price. Futures price can be understood as the price at which futures should quote in futures market. Futures should quote. Fair means what should be the price. Actual means what is the price. Spot market, a share will be quoted in both cash market and futures market. Cash market will give me spot price. Futures market will give me futures price, but depending on date. I can give you one price for gold June 24. I'll give you another price for gold July 24. Gold August 24, gold September 24, gold October 24, gold November 24, gold December 24. I can give you different prices for different dates. Today I'll give you the price. Today I'll give you the price. But this is for the futures. This is for the future market. Futures market. When you go to the futures market, it will give you actual futures price. It will give you actual futures price. Spot market will give you spot price. Today, gold is at 65,000. That the spot market can give. Futures will tell you 70,000 is the price. That is the futures price. Using the spot price, I can calculate something called as fair futures price. I can calculate something called as fair futures price. So if spot price changes, fair futures price will change, and even actual futures price will change, because AFP and FFP will more or less be closer to each other. Actual futures price and fair futures price have to be closer to each other. So if there is an increase in spot price, you will see an increase in FFP and AFP. If there's a decrease, you will see an opposite happening. We can compare FFP and AFP, and on the basis of that, I will decide whether futures are overvalued, undervalued, or correctly valued. You cannot compare spot price with the futures price. You can compare only fair futures price with the actual futures price. Why are we doing this comparison? For doing something called as arbitrage. Any transaction in futures market, if you are going and buying something in futures market, you can buy only at actual futures price. You can buy only at actual futures price. You did your calculation and say that I want to buy at that rate. You cannot do it. That is fair futures price. Your calculation can only give you fair futures price. Your calculation cannot result in, cannot help you in buying the price at that price, buying the product at that price. Your calculation can give you fair futures price, actual futures price. So we will do a lot of places. Value of one contract we have to calculate. Value of one contract is equal to lot size into the actual futures price, not fair futures price. Many questions the data will be missing, AFP will be missing. If that is missing, FFP is the proxy for AFP. Fair futures price is the proxy for actual futures price. First format I'm going to introduce is to how do I do futures valuation. That's the format one. Second format, how to do hedging. And then I'll move to the third format, which is to calculate net realization, net profit or net loss. This is what futures is all about. We'll just do three formats and complete the entire futures analysis part. Now, for doing this calculation of fair futures price, I need certain data point. You need not note down anything. Be in listen mode. First, I need spot price, which let's assume is rupees 2000. Then I need rate of interest, which question can give you 12% per annum. I'll convert this into 6% per half year. 12% per annum is technically 6% per half year. I can also say this is 3% per quarter. I can also say this is 1% per month. Is this conversion needed? Not technically needed, but this makes it easier for me to solve the question. Then I'll have a time period. What is time period? From today, when do you want to calculate the futures price? For what date? You need it for June, July, August, September, October, November, December. How many months is in between? How many months is in between? Let's assume 6 months are there. I'll not write it as 6 months. I'll write 6 months or 2 quarters. 6 months as 2 quarters or 1 half year or 0.5 year or 0.5 year. Then there are something called as dividend and storage cost, which will be there in the question. Let's assume as of now nil. Dividend and storage cost will be there in the question. Dividend or storage cost is basically incurred only in the spot market or earned only in the spot market. Futures do not give you any dividends. You do not incur any storage cost for future. For example, if you physically hold gold, you need to incur storage cost on gold. If you are holding shares of TCS, you will get dividend income. TCS futures cannot give you dividend income. Gold futures cannot lead to storage cost. Gold futures cannot lead to storage cost. So cost or dividend is only for the spot market. Both are there only for spot market. And then I decide something called as a compounding frequency. I need to decide something called as a compounding frequency. Once we decide, practically compounding frequency is continuous compounded. But in exam question, we don't do continuous. Some question we do quarterly, some we do monthly, some we do half yearly, some we do continuous. So I need to decide what is the compounding frequency to be followed, which can also be a simple interest, Once you decide this, my first 16-17 question will be solved using this format. I'll only solve using this format. I'll put it in the format. It will give me the actual futures price, fair futures price, compare, decide arbitrage, and then proceed ahead. I'll also explain what is arbitrage, but arbitrage steps I will not take you through because I've tried all possible ways. Students find it very difficult to grasp it. So in the revision, I don't want to confuse you with the arbitrage steps part of it. Arbitrage gain we will calculate. We will tell the arbitrage strategy. That itself will carry 80% of your exam marks. If steps are asked and you understand steps, you follow them in exam. Otherwise, after the revision, just revise the steps part of it. So steps part of it, something I'll park it for the time being. So what is the formula for futures? Fair futures price is equal to spot price into 1 plus R the whole power N. Now what is the rule is? If you take R as 12% per annum, if you take R as 12% per annum, N is equal to 0.5 years. N is equal to 0.5 years. R and N should be for the same time period. If you say R is 6% per half year, N is 1 half year. If you say R is 3% per quarter, N is 2 quarters. If you say R is 1% per month, N is 6. N is 6. So you just need to ensure R and T is for the same time period. R and T is for the same time period. That is a rule of valuation. That's a rule of valuation. R and T should be for the same time period. That you can also do something called as continuous compounding. How to do continuous compounding, I'll explain, where we do spot price into E power R T. In this R and T combination, ensure any combination you can do 12 and 0.5, 6 and 1, 3 and 2, 1 and 6. Any combination you follow, put together the numerator will be 0.06. Put together the numerator is going to be 0.06 E power R T. Now what is the implication of this? If you are doing daily compounding, which is called continuous compounding, how you get and all, let's see it later. Today the spot price is 20,000. I want to calculate futures for 6 months. 6 months, okay? Let's not worry about the calculation part of it. If you do daily compounding, fair futures price is 21,236.7. If you do monthly, 21,230. If you do quarterly, 21,218. If you do half yearly, it is 21,200. And if you do annual, it is 21,166. And if you do simple interest, it is 21,200. So my answer can keep changing based on my compounding frequency. Based on my compounding frequency. Ideal compounding frequency is continuous compounding. Ideal compounding frequency is continuous compounding. That is what we do in practical world. In practical world, we go for continuous compounding frequency. How to do compounding frequency? We'll see as we proceed. Now, how do I calculate this e power RT? If they give you the table values in the question, great. Otherwise, now write e power 0.10. Let's do e power 0.10 calculation. E power 0.10 is equal to 1 plus, this is how e power 0.10 will be calculated. 1 plus 0.10 by 1 factorial, 0.10 square by 2 factorial, 0.10 cube by 3 factorial. Like this, there is no end to this, but till 3 factorial, we will almost get the answer. We'll almost get the answer. 1 plus 0.10 by 1 factorial, 0.10 square by 2 factorial, 0.10 cube by 3 factorial. This is 1, 0.10. 0.10 into 0.10 divided by 2 into 1. That is 2 factorials 2 into 1. 3 factorials 3 into 2 into 1. 0.1 into 0.1 divided by 2. 0.005. 0.1 into 0.1 into 0.1 divided by 3, 2, 1. 0.000167. 0.000167. Summation of all of this. 1 plus 0.10, 0.005, 0.000167. 105167. That is my e power 0.10. E power 0.10 is equal to 1 plus 0.10 by 1 factorial, 0.10 square by 2 factorial, 0.10 cube by 3 factorial. Is there any need to do this? Practically no. And this answer is also not right. This is not the accurate answer. If I want accurate answer, I have to do 0.10 power 4 by 4 factorial, power 5 by 5. But as you increase the number of powers, the value will keep becoming insignificant. We started with 1, then added 0.10, then added 0.005, then added 0.000167. If you do 0.10 power 4 by 4 factorial, the number will be very insignificant. As you proceed, the number becomes insignificant. What is the exact number if I want? Exact number is this, e power 0.10. 1.105170918. This is the exact number. This is the exact number. If I keep it at 6 decimal, exact number is 1.105171. Number which we have got is 1.105167. So again, I'm repeating, our answer is not accurate. Our answer is not accurate. But I cannot keep doing 4 factorial, 5 factorial, 6 factorial, 7 factorial, 8 factorial, 9, 10, 11, 12. I cannot keep doing it. So at some stage, I put a stop. That stop is put at 3 factorial. That stop is put at 3 factorial. This is how to compute e power x value. What to do continuous compounding, I'll come to it. I'll come to that calculation in some time. Any doubts on this? Now, understand this very clearly. In these two formulae, spot price will change in few situation and R will change in few situation. Spot price will change in few situation, R will change in few situation. I am not giving a new formula. Spot price will change in few situation, R will change in few situation. What are those situations? If you have dividend in rupees, because spot price also includes dividend, I have to remove the dividend. I have to remove the dividend from the spot price because futures does not have any dividend. Futures does not have any dividend. So spot price will be replaced with spot price minus PV of dividend, present value of dividend, or spot price plus present value of storage. Storage cost increases the spot price, dividend decreases the spot price because the share price will fall by the amount of dividend moment the dividend is declared, and if you're incurring extra cost, your price has to be higher because of that. Your price has to be higher because of that. If it is given in percentage, R will be replaced with R minus Y, or R will be replaced with R plus S. R minus Y or R plus S. Formula adjustments. During the futures contract term, underlying assets may declare dividend, or there may be associated storage cost for assets like gold. The spot price is influenced by these dividend income or storage costs, which is not the case for future. Future doesn't get impacted. Dividend and storage cost will impact my formula. What is the change? If dividend is in rupees, minus present value of dividend income, present value, not the normal. And if the storage cost is in rupees, plus present value of storage cost. If it's in percentage, R is replaced with R minus Y, and storage cost in percentage, R is replaced with R plus S. I'll come to these MCQs later. Format for computation of FFP. Spot price, start with, decide what is the time period given in the question, then rate of interest, there's a dividend, there's a storage cost, and there is a compounding frequency. Compounding frequency will have similar issue, will have the most important impact on our final answer, because depending on the change in frequency, our answer does undergo change. I showed you different answer with different frequency. What compounding frequency do I take? Question uses the word CCRFI. We will do continuous. Question uses the word daily compounding. We will do continuous. Question uses the value, e power value is given in the question. Which means they are telling indirectly follow continuous. Question says 1 month interest rate is so much. 1 month interest rate. Question uses the word 1 month interest rate. 1 month interest rate means they are asking you to follow monthly compounding. Interest rate is per annum only, but they want you to follow monthly compounding. Or they say interest rate per month. Again you have to follow monthly compounding. They say per quarter. You have to follow quarterly compounding. If they say 2 month interest per 2 months, you will have to do compounding every 2 months. Other situation, once compounding is done only once, or technically it is called simple interest. What is compounding once is 1 plus R the whole power n. No, power n will be 1. So whatever is the time period, for example, if the question says 6 month, calculate R for 6 month and put power 1. If question say 3 month, calculate R for 3 month and put power 1. Power will be only 1. In all other situation, which is technically simple interest. Now, once we calculate this, we will have to decide whether futures is undervalued or overvalued. If my actual is more than fair futures, it is a overvalued scenario. Actual is more than fair. And if actual is lesser, then it's an undervalued situation. This is an error there. This will be AFP less than FFP. Both are same. There is an error there. AFP greater than FFP, AFP lesser than FFP. That's the situation. You can do the correction later. Just be in listen mode, okay? If your actual futures is more, it is overvalued. Actual futures is less, it is undervalued. Overvalued, you have to sell. Undervalued, you will have to buy. So if it is overvalued in futures market, sell in futures market, buy in spot market. If you want to buy in spot market, you need money which will come in the form of a loan. And if you are deciding to have a undervalued scenario in futures market, you want to buy in futures, sell in spot. If you sell in spot, you get money. You will create a fixed deposit. So overvalued, sell in futures, buy in spot, borrow to buy the share. Undervalued, buy in futures, sell in spot, create FD with the sale proceeds. In exam situation, you just going to write till this only. That is, what is my arbitrage strategy? Where am I going to buy? Where am I going to sell? And where am I going to create? Whether I'm creating a fixed deposit or taking a loan. This is the only limited discussion. I'll have it in the class. In the class only this much discussion will be there. Nothing beyond that. I'm not going to get into the steps because I've tried all possible ways. Steps somewhere confuses you guys. So I don't want to confuse initially. Later on when you see the steps part of it, if you're getting clarity, great. Not getting clarity, ignore the step and just write the arbitrage gain. What is arbitrage gain is, I want both the values to be same. If there is any difference, that's an arbitrage gain. That's all. Any difference, no positive, negative difference. Any difference. If fair futures price is 1000, actual is 800, arbitrage gain is 200. Arbitrage gain is 200. Actual is 1500. Fair is 1000. Arbitrage gain is 500. Difference. Difference is the arbitrage gain. No sign and all. No sign being brought in there. Difference is the arbitrage gain. Be it on the upside, be it on the downside. Any side, it is arbitrage gain. Okay. I'll quickly repeat what I did. I have explained the base concepts. With this, my first part of the derivatives is over. The futures part of it is over. Same explanation I'll give for 20 minutes and options will also get over. My work is over in 40 minutes. It's only that when you read a question, you confuse yourself with so many data that you are finding it very difficult to do it in an exam scenario. Let me again repeat. There are two markets. One is a futures market. One is a spot market. There will be a separate futures price. There will be a separate spot price. Spot price is for spot market. Futures price is for future market. Futures price, there can be 1 price, 2 price, 3 price, 5 price, 10 price, 20 price. I can give different prices for different dates. Different prices for different dates. What is the use of spot price? To buy it in the spot market. What is the use of futures price? To buy or sell in the futures market. To buy or sell in the futures market. What am I going to do with the spot price? Using the spot price, I will use time value of money formula. What is time value of money? Future value is equal to present value into 1 plus R the whole power n. This chapter is only that. This is time value of money chapter. This is not derivatives. What you learnt in time value of money at CA Inter, which looked very simple to you at that point of time, exactly the same thing only I am doing. Exactly the same thing. Future value is equal to spot price into 1 plus R the whole power n. If you are doing any compounding, that is daily, other than daily, monthly, quarterly, half yearly, annual, whatever compounding you do this. If you decide to do daily compounding, do into e power RT. E power RT, how will you get? 1 plus x by 1 factorial, x square by 2 factorial, x cube by 3 factorial, x power 4 by 4 factorial. There is no end to this, but we will stop at 3 factorial. We will stop at 3 factorial. When I do problem, one question I will ask you to calculate e power x. Balance question, I'll quickly take it from Excel. I'm not going to spend time on calculating e power x. That doesn't add any value to us. Okay. Once you get this, you get the fair futures price. Now, in the formula, I need two adjustments. One is dividend, second is storage cost. Why do I need adjustment? Because dividend is there for spot, not there for futures. Storage cost is there for spot, not there for futures. So I need adjustment. How do I make this adjustment? Very simple. If the present value of dividend, if dividend income in rupees is given, subtract present value of dividend income. Storage cost in rupees is there, add present value of storage cost. If it's in percentage, do R minus Y. If it is storage cost in percentage, do R plus S. R minus Y or R plus S, and then we are done with this part of the calculation. Clear? Any doubts in this? Once you get your FFP, compare with AFP. Futures may be undervalued, futures may be overvalued. Overvalued, we sell it. Undervalued, we buy it. Whatever you do in futures, do the opposite in spot. Whatever you are doing in spot, depending on that, take a loan or create a FD. Take a loan or create a FD. In this process, you'll be making arbitrage gain. What is arbitrage gain? Difference between FFP and AFP. Difference between FFP and AFP. Let's see a few questions. When you want to revise, just go through the MCQs. That is sufficient. MCQs can kind of take care of the revision. This chapter, I'm very confident on the MCQs which I've created. It will revise entire part of the chapter, but obviously the numbers will not be so simple in exam. You have so many numbers, and that is where you keep getting confused. So that is why I want to show the bigger question rather than showing a smaller question. Technically, my role is almost over, okay? I don't have anything to do now. Let's come to question 1. Let's start. Stock of Y Limited, non-dividend paying stock, is today selling at 72. You wish to enter into a futures contract on this stock maturing in 6 months time. Risk-free rate of return is 12% per annum continuously compounded. What will the futures price be? If it is 75, what action will you take? If it is 77, what action will you take? Let's put it in the format. Format 1. Spot price, rate of interest, time period, dividend, storage cost, compounding frequency. Write it. Initial 2-3 question, you will see me doing this properly. Later on, I'll go at my speed. So I cannot help it, if I go at that speed, so you will have to get used to it. Spot price, rate of interest, time period, dividend, storage cost, compounding frequency. There's nothing beyond this in this chapter. Format 1, first part of the chapter. What's the spot price? 72. Rate of interest 12% per annum or 6% per 6 months or 3% per quarter or 1% per month. What's the time period? 6 months or 2 quarters. 6 months has 2 quarters. 1/2 year, 0.5 year. It's not necessary to write all of this. Initial, I want you to get used to this. Any dividend in the question? Any storage cost? What is the indication on compounding frequency? Continuous. They have used the word continuous compounded risk-free rate of interest. Continuous. FFP is equal to spot price into e power RT. Spot price into e power RT. E power R and T, any combination you can take. Any combination you can take, but ensure that the combination is right. So I'm taking R is 12%. I'm taking R is 12%. What should I take as T? 0.5. Please do e power 0.06 calculation. First question, I want you to do e power 0.06 calculation. 1 plus 0.06 by 1 factorial, 0.06 square by 2 factorial, 0.06 cube by 3 factorial. One 1.061836. 1.061836. Is this the right number? No, the right number is this. 1.061836547. So we are almost there by doing 3 factorial. Almost there by doing 3 factorial. Any doubts on this number? Any doubts on the number? 72 into what? 1.061836 fair futures price. 76 point. That's all, problem is over. 76.45. This is what students struggle, but unfortunately student struggle with this part of the calculation also. Any doubts on for 76.45? I proceed. Now I come to arbitrage. We will need, I think, 5-6 columns. I don't know the name of the columns as of now. First write FFP equal to 76.45 and AFP. FFP equal to 76.45. AFP. What is the AFP for first situation? 70. And in second column, AFP is equal to 77. This is the first column. FFP 76.45, AFP 75, FFP 76.45, AFP is 77. First situation, let's close first situation and then I come to second situation. Is futures undervalued, overvalued in the market? What you get is the right price. What market gives is the current price. Market may overvalue it, undervalue it. You wanted at 76.45. Market is saying what price? 75. Market undervaluing, overvaluing? Undervaluing, undervaluing, undervalued. Action in futures market. Action in futures. Action in futures. What do you want to do in futures? Action in spot. Opposite of that, okay? Opposite of that. If you sell the share, you will get money. FD slash loan. Will you create a FD or take a loan? Guys, participate, please. Will you create a FD or take a loan? Create FD. Create FD, and last line is arbitrage gain, which is just the difference. Which is just the difference. That's all. No sign attached there. Arbitrage gain. How much is the arbitrage gain? Now, in exam question, they may give a lot size, saying that one lot is equals one futures is equal to 100 shares. So our profit will not be 1.45. Profit will be 1.45 into 100. Profit will be 1.45 into 100. Normally, we assume a lot size. So here you can write 145 and write a note. Lot size assumed as 100. Lot size assumed as 100. Clear? Lot size assumed as 100. Any doubts on this? The shares in the spot means we are assuming that we have short sell. So don't get into all that. So you unnecessarily complicate things. Okay, sell. That's all. There is something called as a short sell which will happen otherwise. Any doubts on this? E power you will have to do. You missed the initial part. No. What should I do? I'll after the class only I'll explain. Okay. Now coming to the next situation. Ignore what you wrote earlier. FFP 76.45. AFP is 77. Market undervaluing, overvaluing. Right, overvalued. If it's overvalued, what will you do in futures? What will you do in spot? How will you buy the share? Take loan. Arbitrage gain difference. 55 rupees. 55 rupees. 0.55 into 100. 0.55 into 100. Clear? Any doubts on this? I'll keep doing this only every question now onwards. I'll keep doing this. Only extra add-ons I will add. I will add extra add-ons which is technically something on, sorry, I'll add extra add-ons which is something on dividend and storage cost. Any doubts on this first? Can we proceed? Let's come to 5. Gold futures have been opened up in India recently. A 3-month gold futures is available at 800 per gram. Suppose the current price of the gold is 775 per gram and it cost 5 per gram in arrears for the 3-month period to store gold. What is the fair price if CCRFI is continuous compounded risk-free rate of interest? If the rental is 4% per annum instead of 5 per gram and the CCRFI, what is the fair price of gold future? Third part has a new concept called convenience yield, which I'll discuss in MCQ. I'm not discussing it now because I want the thought process to go in the same manner as of now. So here both are there. Storage cost in rupees is also there. Storage cost in percentage is also there. Two different situation. Okay, two different. In one question also both can come. If there is a storage cost in rupees as well as storage cost in percentage, rupees adjust with spot price and percentage adjust with your R. Adjust with your R. Let's start. Put the format. Have two columns, okay? One column for the first situation, second column are, okay, two situations are there. One with storage cost being this and another one storage cost is different. Put the format: spot price, rate of interest, time period, dividend, storage cost, compounding frequency. I'll explain convenience yield later on. Tell me what is the spot price? 775. Rate of interest 8% per annum. Time period 3 months. I'll do the adjustment later. 3 months. Dividend. Storage cost rupees 5 in arrears. Arrears means it will be incurred in month 3. Rupees 5 in month 3. Or the rework situation is, or that's a rework situation. Rework situation, what's happening? 4% per annum. That's a rework situation. Okay, I'm just written both here. Written both here. 4% per annum calculation I'll explain later. First I'll do rupees 5. Rupees 5 in month 3. Compounding frequency. First job of ours is, this is the situation. We are here. Storage cost is incurred here. 5 has to be brought to today. 5 has to be brought to today. 5 has to be brought to today. Present value of storage cost is equal to, present value of storage cost is equal to 5 divided by e power rt. 5 divided by e power rt was the rate of interest 8%. Time period is 3 by 12. Time period is 3 by 12. Time period is 3 by 12. 5 divided by e power 0.02 is 4.90. 4.90. It has to be and it will be 4.90. Any doubts on this? Please, for the time being, ignore that 4%. Don't bring 4% into mind, because otherwise you'll get confused. That's a rework situation. To save time, I've written it together. Just to save time, I've written it together. Fair futures price is equal to, adjusted spot price into e power RT. Adjusted spot price into e power RT. What is the normal spot price given? Add the present value of storage cost into e power R is 0.08, T is 3 by 12, 0.08 and 3 by 12, which is 1.0202. Multiply and tell me the answer. 1.0202. 795 point. I don't want to spend any time on explaining to you e power value, because that is where I did one example, you did one calculation. Beyond that, e power x value you will have to do. Without doing e power x value, you will get stuck in exam. Okay, many times they miss out giving the value, sometimes they give it also. Any doubts on this? Can we proceed? Rework situation, storage cost is what? In percentage. Same formula, but you will have to do e power r plus s, r plus s, r plus s. Dividend means minus, storage cost means plus. So next, FFP is equal to spot price into e power r plus s, e power r plus s into t, e power r plus s into t. What is the spot price? 775 into e power, what is the r? 0.08, s 0.04, t is, just ensure that you maintain consistency. 8% per annum, 4% per annum, 3 by 12 years, 3 by 12 years. 775 into e power, what you have to do? Into e power 0.03. Answer is 798.60 into 0.03. E power 0.03. How to calculate? Let's not keep continuing to worry about it. Any doubts on this? Can we proceed? Any doubts on this? What is convenience yield? Okay, I'll explain now the concept of convenience yield. What is convenience yield is, you calculated the fair futures price. Formula gave you fair futures price, and there is an actual futures price in the market. Formula gave you fair futures price and there's an actual futures price in the market. For example, spot price 800, cost to carry is 20. What is cost to carry? We'll see it later. Okay, you need to consider 810 as the fair futures price. You need to consider 810 as the fair futures price. If you apply formula, you will get 820. If you apply formula, you will get 820. Formula will give you FFP. Formula will give you FFP. But question says, no, what you are saying is not right. I am telling you, you follow this. I am telling you, you follow this. The fair futures price given in the question is different and fair futures price as per formula is different. Formula can only give you FFP, but question tells, I am telling you this, you follow this. The gap is called convenience yield. The gap is called convenience yield. Let me explain what is convenience yield. When you buy a spot market, when you buy in spot market and when you buy in futures market, there is a difference. Buying in spot market has one extra benefit because you can utilize the asset if you want. For example, I have gold. I've got gold. Buying it in spot market, the gold, I can use gold if I want. Buying in futures market, I cannot use it. Futures market also has an end limit. End limit is 3 months, 6 months, 9 months. So assume gold is scarce. Gold is not at all available and every day price is going up. Every day price is going up. Futures is also going up. As spot goes up, futures also goes up. But unfortunately, after 3 months, spot continues to grow. Futures will not grow because the contract is over. The contract is over. That is why many people feel there is a benefit of holding the inventory in physical form. There's a benefit of holding the inventory in physical form as compared to holding it in the futures form. As compared to holding it in the futures form. If there is any extra benefit, that extra benefit is called convenience yield. That extra benefit is called convenience yield. The name is called convenience. It is convenient to hold it in physical form. It is convenient to hold it in physical form. Now, how do I calculate convenience yield? Let me go to this question. You had spot price 775. Futures price you calculated 798.60. The gap between this is called cost to carry. The gap between this is called cost to carry. FFP as per formula minus the spot price. FFP as per formula minus the spot price is called cost to carry. Is called cost to carry. Cost to carry refers to the total expenses or cost associated with holding an underlying asset until expiration of futures contract. It includes various components such as interest cost, dividend, storage cost. Cost to carry is equal to FFP as per formula minus spot price. What is the 798 minus 775? Storage cost I need to incur. I need to incur storage cost. Also, if you physically buy gold, you would have put some money in that. That money would have earned you interest income. That money would have earned you interest income. That is called cost to carry. I did all that. I got the cost to carry. Okay. I did this. I got the cost to carry. Now, suddenly question is saying what you are telling is wrong. What you are telling is wrong. I am telling you follow this. I am telling you follow this. So then comes the next formula. Fair futures price is equal to spot price plus cost to carry. Spot price plus cost to carry minus the convenience yield. Spot price plus cost to carry minus the convenience yield. Minus the convenience yield. In short, it is the difference between FFP as per formula and FFP as per question. It is not difference between FFP and AFP. That is arbitrage. Okay. That is arbitrage. You calculated something. I don't follow what you are calculating. I don't agree to what you have calculated and I am telling you please follow this. Please follow this. If that happens, convenience yield will get created. Convenience yield will get created. You'll understand it better when I do a problem. I'll do a problem. You'll understand it better. For example, last question. We are not doing the last question, but if the futures price of 770 is to be considered as fair, they are saying you consider 770 only is fair. You consider 770 only is fair, not what you calculated. Not what you calculated. It will lead to convenience yield. It will lead to convenience yield. Let's come to the next question. Spot price 15,600. futures price 17,100, risk-free interest rate 8.5%, present value of storage cost 900. From the above information, you are required to calculate what? Convenience yield. I am required to calculate convenience yield. Let me first do FFP as per formula. Let me do FFP as per formula. What is FFP as per the question? 17,100. FFP as per the question is 17,100. If there is a difference, it will lead to convenience yield. Let's put it in our usual format. Tell me the spot price. No need to write now onwards. We have done one question in all the category. Okay. What's the spot price? Rate of interest 8.5% per annum. Time period. Dividend. Guys, please participate. I want everyone to participate. Dividend nil. Storage cost 900 when? On day zero. On day zero. Compounding frequency. Anything mentioned about continuous E power value given in the question? 1 month interest, 3 month interest, 5 month interest, anything like that? No. Once a year. Once a year. What is once a year? Is once a time period. Simple, basically simple interest. We are going to follow simple interest. Once in a year, or technically it is simple interest, or technically it is simple interest. Fair futures price is equal to adjusted spot price into 1 plus R power n. N will be always 1. Power n will be 1. You will have to do it in that manner. You will have to do it in that manner. 1 plus R power n you can write, but n will be only 1. N will be only 1. Moment you write n1, there is no compounding happening. There is no compounding happening. Tell me the adjusted spot price. 16,500. 15,600 plus 900 into 1 plus 8.5%. 1 plus 8.5%. What's the answer you got? 17. Now, this is what is the fair futures price. Question is saying, no, I don't agree to what you are saying. I'm giving you some other number. I'm giving you some other number. Any doubts on for 17,902? Cost to carry is, what was the spot price? Difference 17,902 minus 15,600 minus 15,600. This is called cost to carry. Some question may ask you to calculate a cost to carry. Don't focus much on writing now, because I know when I will tell you to write. Whenever I know things are critical, I'll tell you to write. Otherwise, be in listen mode, because focus in this chapter cannot be on writing. Focus has to be only on understanding things. Any doubts on 2302.5? Can we proceed? Now comes the convenience yield. Now comes the convenience yield. What is convenience yield? Is compare the FFP as per the formula and the FFP as per the question. FFP is future. FFP is future. So future value of convenience yield. Future value of convenience yield is equal to 17,902 calculated by me. What did the question say? 1,700. Tell me the difference. This is called future value of convenience yield. Why future value? Because you are comparing two futures price. You are comparing futures price. FFP as per formula with FFP as per question. FFP as per formula with FFP as per question. Then comes present value of convenience yield. Discount this 802.5 divided by 1 plus 8.5%. 7. Any doubts on this? Any doubts on this part? Can we proceed? Any doubts? Let's come to question 7. Again, I don't want you to write anything. Wherever it is to be written, I'll let you know. Very simple data. All the information is available. This is an exam question. This is an exam question. Tell me the data. Nothing much for you to read also. Spot price. Guys, I want everyone to participate. Please. Spot price. 1,000. Rate of interest. 12% per annum. Time period. Dividend. Storage cost. Compounding frequency. Not once a year. Once in 6 months. Once in 6 months, because the life is 6 months. The life is 6 months. There is no specific frequency. Simple interest. We are going to follow simple interest. Once in 6 months. Once in 6 months. Clear? Any doubts on this? Fair futures price is equal to spot price into 1 plus r power n. 1 plus r power n. What is the spot price? Into 1 plus, tell me the 6 months interest. 1 plus 6% power 1. 1 plus 6% power 1. What's the value? 1908. Go here. Give me the FFP is 1908. AFP 19 situation. Over valued. Action in futures. Action in spot. How will you buy? Take loan. Arbitrage gain. 42 or 42 into 100. 42 or 42 into 100. Any doubts on this? This was a 8-mark exam question. I don't know what is there in the question itself. And invariably students struggle. Invariably students struggle with these questions. Any doubts on this? Can we proceed? Okay, now coming to the dividend yield, one concept I have to touch in dividend yield. One concept I have to touch and then I come back here. Dividend yield computation. Normally dividend yield is applicable. Normally dividend yield is applicable for a scenario like an index. What is an index? Nifty is an index. Sensex is an index. Nifty comprises of so many companies. Sensex comprises of so many companies. 30 and 50 companies are there in the index. First month somebody will declare dividend. Second month somebody will declare dividend. Third month somebody will declare dividend. So it was not possible for me to exactly find who is going to declare dividend when. That is why we have yield. We have yield. But the problem is the question may give yield like this. January 2%, Feb 4%, March 6%, April 4, May 5, June 9, July. Different percentages for different month. Different percentages for different month. No, I am stuck scenario because I see different percentages for different months. So how do I do calculation here? Average yield for the time period the future is going to exist. That is from today. If you're doing today, March till June, what is the average yield? If you want to value June futures. March to September, what is the yield? If you're doing September future. Here, what should be taken as dividend yield for valuing a 4-month futures which expired on when? November 30. 4 month means from November 30 come back. August, September, October, November. Because November 30 is the expiry date. November 30 is the expiry date. 4 months, what is the average? August, September, October, November. 4 point. Please use that in the formula. Please use that as the dividend yield. In your formula, the dividend yield which we are going to use is the average of the dividend yield of these months. Average of the dividend yield of these months. Clear? Any doubts on this? Can we proceed? Let's come to this question now. On 31/8/2011, the stock is at 2,200. Risk-free rate of return is 8%. Dividend yield on this index is Jan to December is given. Assume that interest is compounded daily. Compounded daily. Daily means continuous. Find out the futures contract of a contract deliverable. E power value is also given in the question. E power value is also given in the question. Nothing much for you to note down. Tell me the values. Spot price. Rate of interest. 8% per annum. Time period. Please tell me the average dividend for these 4 months. Starting from September on 31/8. So September, October, November, December. 3 point. Again, this is per annum only. It's average of 4 months, but this is a per annum rate only. This is a per annum rate only. Storage cost, compounding frequency, continuous. FFP is equal to spot price into E power R minus Y into T. E power R minus Y into T. What's the spot price? 2,200 into E power R is 0.08, Y is 0.0325, T is 4/12. Nothing much for you to do. The value is given there. You multiply with that and then close it. Clear? Any doubts on this? The E power value is given. If it's not given, you have to calculate. You have to calculate. Any doubts on this? Come to 11. Suppose current price of an index is 13,800. Yield on index is 4.8% per annum. A 6-month contract on index is trading at 14,340. Assume that risk-free rate of interest is 12%. Show how Mr. X, an arbitrager, can earn an abnormal rate of return irrespective of outcome after 6 months. You can assume that after 6 months, index closes at 10,200 and 15,600, and 50% of stock included in index shall pay dividend in the next 6 months. Also calculate implied risk-free rate. I'll do arbitrage, I'll do implied risk-free rate. There's one part of the calculation earning abnormal rate of return, that is showing the steps when it is 10,200, 15,600. I'll explain that as we proceed. Let's put the data first. Spot price 13, rate of interest 12% per annum, or how much is the time period? 6% per 6 months. Time period, dividend per annum, in that 50% will pay for our time period, so 2.4% per 6 months. 2.4% per 6 months. Any storage cost? Compounding frequency, once in 6 months. Technically simple interest. FFP is equal to spot price into 1 plus R minus Y power T, R minus Y power N or power T, whatever name you want to give. What's the spot price? 13,800 into 1 plus R is how much? 6%. Y power 1 anyway. What's the answer you get? 14,296.8. What is the actual futures price? FFP 14,296.8. AFP 14,340. Undervalued, overvalued? Overvalued. Action in futures market. Action in spot. FDR loan. Arbitrage gain 43.2. Okay, any doubts on this? Now question has said you show your working if the index closes at 10,200, our index closes at 15,600. Now what action did we take in the futures market? Sell. In spot market, buy. So after the time period, after whatever time period happens, we'll have to sell. That is, I'm buying today in the spot market. I am going to sell the share in the futures market later on. I'm going to sell this in the futures market in future. Today I am buying it. I'll sell this. Actual sale in reality will happen only at 10,200 and 15,600. Actual sale will happen only at 10,200 and 15,600. Then what will happen? There will be something called as a net settlement. There will be something called as a net settlement. How net settlement is calculated? That is my second format, which I'll introduce after 3-4 questions. I'll introduce net settlement concept after 3-4 questions. So at home, if you see the steps, you find that there is a profit or loss from the cash position. There's a profit or loss from the futures position. This profit or loss from futures is called net settlement. Which I would want you to see at home after we are done with net settlement understanding and after you have seen initial arbitrage steps. If still you are not able to proceed, then please ignore the steps part of it. I cannot help it because I don't want you to confuse the other major part because you are not getting clarity on the steps part of it. You are not getting clarity on the steps part of it. Any doubts till this first? Okay. Question last line says implied what? Implied risk-free rate. Let me first explain this. Engaging in arbitrage within the market creates an implied return, surpassing the standard risk-free rate. Risk-free rate is without taking any risk. And arbitrage is also without taking any risk. This is attributed to generation of extraordinary profits without taking any risk during the arbitrage process. In this problem, what is the risk-free rate? Tell me. You can write this in a minute because my printed solution is different. Okay, 12%. How much is the arbitrage gain you will make? 43.2. What is the spot price given in the question? This 43.2 is in how many months? Into 12 by 6 into 100 to annualize this. Okay, 12% is annual. Listen, if you make arbitrage gain, your implied risk-free rate will be more than the normal risk-free rate. What is risk-free rate? Without taking any risk. In arbitrage, I don't take any risk. I have not explained the detailed step, but if you go through them, you'll understand I take zero risk. In case you really want to understand the arbitrage steps fully, full explanation is needed. In my YouTube channel, first two videos of derivatives is uploaded. First two videos, regular class video. So there, the arbitrage steps are also explained. There, the steps of arbitrage are also fully explained. I don't want to spend that time now. So 12 plus, can you tell me how much is this? 63. This will be the answer in the material after doing lot of detailed step. Okay, after doing lot of detailed step, please write this alone in this, either in the book or in your notebook. Better write it in the book. Implied risk-free rate is equal to normal risk-free rate plus arbitrage gain by spot price into 12 by m into 100. Just do into 12 by m into 100. Into 12 by m into 100. You can write it in the book itself. The solution in the book is not done this way. This is easier to do. Into 12 by m into 100. Clear? 12.63%. The printed solution as presented is slightly different. Again, I'm repeating, I am not getting into the steps part of it because it will unnecessarily complicate whatever I want to teach you now. Clear? Okay, now comes the second format. We are going to get into net settlement. Okay, 12th question itself, we are getting into net settlement. Now, what is net settlement? Let's understand. Today, you can decide, guys, be in listen mode. Important part. You can decide today to sell something in future. You can decide today to buy something in future. So I went to a shopkeeper. I told on December 31, I'll buy gold from you at the rate of 7,000. I'll buy gold from you at the rate of 7,000. I entered into a contract with him. What happened is by December 31, gold prices crashed down to 4,500. Gold price crashed down to 4,500. What agreement I entered? 7,000. I said I'll escape from this agreement now. I said I'll escape from this agreement because I told I'll buy at what? 7,000. Market is saying what? 4,500. If you want to escape, you'll say pay a penalty of the gap. Pay a penalty of the gap. That gap is called net settlement. That gap is called net settlement because you told you will buy at what rate? 7,000. And you after, yeah, please tell me. What happened? You decided that you will buy at 7,000 and after the time period, you suddenly wanted to escape from that place. You suddenly wanted to escape from the place. Why are you escaping? Because it's not favorable for you. It's not favorable for you. Future says, yes, you can escape, pay a penalty and escape. Pay a penalty and escape. And futures normally have net settlement in the practical world. We have only net settlement in the practical world. We don't have a gross settlement. We don't have a gross settlement. We do only net settlement. How are we going to do this net settlement? I have a format. I'll explain the format now. Date. This is my format too, which you may have to remember. Date, position, action, reference date, and rate. Very simple format. If you remember this format, it's there in the concept book. No need to write anything. Just be in listen mode. Understand it. Today, March 21, I enter into an agreement. Original position. I enter into an agreement. What agreement? I tell the shopkeeper. That I will buy gold when? December 31. At what rate? Buy is negative for me. Okay, buy is negative for me. I told him I'll buy at 7,000. I told him I'll buy at 7,000. So I've written minus 7,000. I've written minus 7,000. Then came December 31. Then came December 31. I smartly wanted to escape. If you want to escape, he will say do opposite position. Do opposite position. What is opposite of buy? It will be sell, same date. These two dates have to be same. That is, the contract can be entered for December 31. Cancellation should also happen with December 31 price. You enter into a contract with a December 31 price and say immediately cancel now with today's price. That cannot happen, because futures have different price for different dates, different price for different dates. So now in the market price is 4,500. Now in the market price is 4,500. If I put a total, if I get positive, it is profit for me. If I get negative, it is loss for me. So in this contract, I have to pay 2,500 to the shopkeeper. I have to pay 2,500 to the shopkeeper. Opposite can also happen. I entered at 7,000. Gold price have now touched 11,000. Gold price have now touched 11,000. Shopkeeper is saying he doesn't want to give me gold at 7,000. He doesn't want to give me gold at 7,000. I tell him we entered into an agreement. You have to give at 7,000. He says let's do a net settlement. I have no problem. Opposite, I'll put 11,000 here. Opposite, I'll put 11,000. I get profit. I get profit. He will give me 4,000. He will give me 4,000. Date, position, action, reference date and date. Date refers to the date on which you enter a contract or cancel a contract. Date refers to the date on which you enter or cancel a contract. Position is there is an original position and there is a opposite position. Action, one will be buy, one will be sell. Reference date, for what date? Today you can enter a contract for September 30, for June 30, for December 31, for March 31. For any date you can enter a contract today. Any date you can enter a contract today. And rate is nothing but the rate at which you enter the contract. Let's look at this question now. We will do it together. Right, date, question, action, reference date and rate. Question 12. Okay, Mr. X bought Nifty futures on which date? 1st January. So write date Jan 1. The date on which you enter the contract. Jan 1. Jan 1. What is it? Original position. Jan 1 is original position. What did you do on Jan 1? Buy. For which date? March 31. At what rate? 10 lakh divided by 200. 10 lakh divided by 200. 10 lakh is the value, divided by 200. How much? Not 5,000. Minus 5,000. Minus 5,000. If you're writing by, please write minus. Please write minus. Clear? Then I come back on the maturity date. I come back on the maturity date. When is the maturity date? Opposite. Come back on the maturity date. Opposite position. Opposite is what? Sell. On March 31, what is the March 31 rate? 6,000. Total plus minus. Profit per unit. Profit per unit, which is how much? 1,000. And profit per contract. Profit per contract. What is the lot size? Into 200. Same table you will repeat, but your opposite position is at a different rate. Here you are making profit. If you get a negative total, you are making a loss. Negative total is loss. Positive total is profit. Any doubts? Clear? Can you proceed? Any doubts on this? Understood? Opposite, I'm not doing it the other rate. Okay. Any doubts on this? So remember this: date, position, action, reference date and rate. This is my format 2. This is my format 2. Date refers to the date on which you enter a contract. Position refers to original or opposite. Action refers to buy or sell. Reference date refers to the date on which the contract will be executed. The date on which contract will be executed. And rate refers to whatever the rate. It can be plus, it can be minus. Go through 19. Go through 19. Guys, please go through it. We complete 19. First segment will get over. Then we can take a break. Please go through 19. Okay. Mr. SG sold 5 4-month contract. Please read words properly. Sold 5 4-month contract for rupees 9 lakh. At the time of closing of trading of last Thursday of May 2020, index turned out to be 2100. I sold when? 1st February, 4 months contract. I sold at what rate? I don't know. Index has turned out to be 2100. Contract multiplier is 75. Price of one future contract is very simple. 9 lakh divided by 5. 1 lakh 80. 1 lakh 80. I will come to this approximate Nifty Sensex in a minute. Contango and backwardation I'll explain. Payoff of the transaction. Payoff of the transaction is nothing but profit or loss. Can you put in date, position, action, reference date format? If you sold on day 1, you have sold on day 1. Do the calculation. You have sold on day 1. Date, position, action, reference date, rate format. You have sold on 1st Feb. The sale happened on 1st Feb. Opposite transaction will happen on 31st May. At what rate did we sell? 1,80,000 divided by 75. I make a profit per unit. How many contracts did we do? Profit for 5 contracts. 300 into 75 into 5. Very simple calculation. 1,12,500. 1,12,500. Any doubts on this? I just need to explain that contango and backwardation. That I'll explain. Any doubts till this? Can we proceed? Any doubts? Okay. Let me come to this format which we normally use. Question says, calculate the approximate Nifty Sensex as on when? 1st Feb 2020 if the price of the futures contract on the same date was theoretically correct. So they are asking what is this? Spot prices question mark. Spot prices question mark because futures is given in the question. Futures is given in the question. Spot price approximate Nifty Sensex when? 1st Feb 2020. 1st Feb 2020. What is the rate of interest? Per annum or tell me for 4 months what will be the interest for 4 months? 3% per 4 months into 4 by 12 into 4 by 12. What is the dividend? The time period is 4 months. Dividend yield 6% per annum per 4 months. Storage cost once in 4 months are technically simple interest. Technically simple interest. You want to technically follow simple interest. So what we are going to do? FFP is equal to spot price into 1 plus r minus y power t. FFP is given in the question, which is 2400 on 1st February. On 1st February, spot price is question mark into 1 plus 0.03 minus 0.02. Net spot is 2400 divided by 1.01. Divide by 1.01. Like from spot we calculate futures. From futures also we can calculate spot. Any doubts on this? Any doubts on this? Clear? Done? Okay, I'll quickly explain this contango and backwardation explanation. You can understand contango or backwardation as the cost to carry. You can understand it like the cost to carry. It's the difference between spot price and futures price. In a normal scenario, futures price should be more than the spot price. In a normal scenario, futures price should be more than the spot price, because that is the growing scenario. That is the growing scenario. Futures price should be more than the spot price. That's a normal scenario. That's the normal scenario. Normal market is called contango market. Normal market is called contango market. Backwardation is the opposite market. Backwardation is the opposite market. Just give me a minute. Normal scenario, spot price 2000, futures price 2050. Normal scenario, spot price 2000, futures is 2050. This type of a market is called contango market, upward sloping. Contango market, upward sloping. Reverse scenario, spot price 2100, futures is lesser. When can this happen? This can happen if we are very sure that in future the share will only go down. If we are very sure that in future the share is going to go down, our gold prices will go down, gold prices will go down, then it can be a downward sloping, which is called backwardation market, How do I find backwardation market? By calculating something called as basis. You have to calculate this in exam scenario. Okay, basis in this question was 2376 minus 2400. 2376 I had done the calculation, minus 2400, basis is minus 24. If you get a negative basis, it's a contango market. If you get a positive basis, it's a backwardation market. If you get a negative basis, that's a formula for basis. Formula for basis is spot minus futures. This you may have to remember. But only logic I know is market prices going up. That is a contango market. But if it reverses, that's a backwardation market. Can you tell me what is this market? Spot price 2400, fair futures price 2300. Sorry? Backwardation market. This is a backwardation market. So futures is lower, hence it's a backwardation market. What is the backwardation? Around 100. 100 is the backwardation. Clear? Any doubts on this? Okay, I'll take a break. I'm taking a break of 30 minutes. Reason is simple. 10 minutes you take rest, 20 minutes you revise. Revise what we did. Okay. So please go through whatever was done. If you want to solve some question, please solve it. Okay, let's proceed now. I'll just summarize what we did in the first part of the chapter, which is on technically valuation of futures and calculation of net settlement. The second part is going to focus on hedging part of it. So before that, I'll quickly summarize what we did here through the concept book. So we first started with understanding what is futures price and spot price. There is a spot market which gives you spot price. There's a futures market which gives you futures price. Spot price can be used to calculate fair futures price. Both can be interlinked, and that will help you in letting to know whether there is a undervaluation or overvaluation and an arbitrage opportunity. How do I value futures? Fair futures price is equal to spot price into 1 plus r the whole power n, or spot price into e power r t. This formula needs certain adjustments. What are the adjustments? Okay, how to compute e power rt values? E power rt values is 1 plus x by 1 factorial, x square by 2 factorial, x cube by 3 factorial, and it goes on, but we'll stop at 3 factorial. Formula adjustments. What adjustments do I need to make? If there is a dividend given in rupees, remove it from spot price, adjusted spot price minus PV of dividend. And if there's a storage cost in rupees, adjusted spot price is equal to spot price plus present value of storage cost Then the other adjustment is if it's in percentage. If it's in percentage, R is replaced with R minus Y, or R is replaced with R plus S. Quickly get me an answer to this. 1 minute. Present value of dividend is 2 divided by e power 0.01. That will give me adjusted spot price into e power 0.03 is the value of the futures, which is turning out to be 102.02. Give me the answer to this. Okay, answer will not be possible because the e power values are not there. Interest rate is 12% per annum. What is the? Let me see if I've done. Normal discounting. Do normal discounting. Do normal discounting. CCRFI word is not there. Do normal discounting, normal compounding. Storage cost in rupees adjustment. Where is the difference? Okay, so there's an error in the question. So let's not worry about it. I'll change the question. It has to be 1 rupee here. Okay, that's okay. Some mistake has happened. I'll correct the error. Let's focus on the next question. There is an error there. Spot price of gold is 800. Interest rate is 12% per annum. What is the fair price of 3-month future if storage cost of 5 is to be paid in month 3? What is present value of storage cost is equal to what? 5 divided by 1 plus 3%, 3-month interest. You get the present value, add that to 800 and multiply with 1 plus 3%. Multiply with 1 plus 3%. This we discussed in that problem we did. Dividend yield computation. When you are calculating your dividend yield, you will have to take the dividend yield for the period for which you are doing the valuation. Dividend yield for the period for which you are doing the valuation. Format: spot price, time period, rate of interest, dividend, storage cost and compounding frequency. The same format I can do if I have to do a reverse working of spot price at home. Just try doing these questions. This will give you more clarity. The MCQ itself is sufficient to revise what we have done. What compounding frequency do I use? Word CCRFI, daily compounding, e power value given, do continuous. Otherwise, 1 month interest rate is given, 2 month interest rate, 3 month interest rate, do respective month. If nothing is there, simple interest are compounding once. Simple interest are compounding once. Tell me the answer to this. What frequency you will do? What compounding frequency you will use? Monthly will follow monthly compounding. So 100 into 1 plus 1% power 3. 1 plus 1% power 3. If my actual futures price is greater than fair futures price, overvalued, sell in the futures market, buy in the spot market and borrow, and the arbitrage gain is difference between FFP and AFP. Same will happen in the other side also. Implied risk-free rate is, if you employ arbitrage, your implied risk-free rate is more than the normal risk-free rate, which is normal risk-free rate plus the amount of arbitrage gain divided by the spot price into 12 by M into 100. What is cost to carry? Cost to carry is the difference between FFP as per formula and the spot price given in the question. What is convenience yield? FFP as per formula and FFP as per question. That is future value of convenience yield. Divide by the discount rate, you will get the present value of convenience yield. Contango and backwardation market is computed. Contango and backwardation market is computed with the help of basis. Contango market means futures is more than spot. Backwardation is opposite. Futures is lesser than spot. Okay, how we calculate beta? We know this beta calculation, standard deviation of security by standard deviation of market into correlation coefficient. Same thing is there. There is a SD of spot price. There is a SD of spot prices, security, futures is market. Futures is market into correlation coefficient. What is the use of beta? You will understand as we proceed. So SD of spot by SD of futures into correlation coefficient. Now, what is the use of beta and change in price? This relationship we saw when we were doing there. Beta and change in price. If beta is 2 times and market changes by 5%, our security will change by 10%. Our security will change by 10%. If beta is 3 times, our security has changed by 3%. If beta is 3 times, our security has changed by 3%. Market will change by 1%. Beta is 3 times our security. Our security has changed by 3%. Market will change by the 1%. Market will change by. If market change is given, you can multiply with beta. Security change is given, divide by beta to get the market change. Divide by beta to get the market change. Can you give me the answer to this? Increase, decrease. Please answer that also. Increase of 10%. Market would have increased by 10%. Physical settlement and net settlement. Practically only net settlement will happen. What is physical settlement is when I entered a contract. I gave an example. On December 31, I pay that money and get gold. Pay that money and get gold. So you have entered into a contract to buy gold at 5,000. Contract was entered today to be executed after 1 year. Price of gold after 1 year is 5,600. In physical settlement, I will pay 5,000 and the shopkeeper will give me gold. Shopkeeper will give me gold. In net settlement, I will do date, position, action, reference date and rate and decide the settlement amount. Decide the settlement amount. In this example, 600 rupees is the settlement amount. Why net settlement is okay? So in net settlement, the shopkeeper will give me 600. I wanted to buy gold at 5,000. I wanted to buy gold at 5,000. 5,000, put the 600 which you received and buy it in the market at 5,600. Buy it in the market at 5,600. You wanted 5,000. Which will happen? Which will happen? Net settlement ensures that you get it at 5,000. Net settlement ensures that you get it at 5,000. How does it ensure? You get the 600, put your money and then get it at 5,600. There is one challenge to this. I'll explain that challenge called as a basis risk. I'll explain that as we proceed. Date on which contract was entered. Position is original position and opposite position. Action buy which is long, sell which is short. Reference date is expiry date of the futures contract or execution date. Price positive if position is sell and negative if position is buy. Can you give me the answer to this? You will have to do the futures price calculation. It's not given there, okay? You will have to calculate the futures price first. What is it trading at? 125. Dividend of how much? Present value of dividend 4 divided by 1.08. 125 minus 3.70 into 1 plus 8%. That is the rate at which I entered the contract. Then 125 became 117.5. Again, another rate you have to calculate. This is same as the problem we did. We did one problem on this and accordingly the profit or loss will be calculated. Give me answer to this. This is faster to do. Give me answer to this. Date, put it in date, position, action, reference, date, rate format. Please put it in that format. Please put it in date, position, action, reference, date, rate format. You will understand something once you put it in that format. Date, position, action, reference, date and rate format, please. Put it in that format. There is some major learning there in this question. Jan 1 original position, what did we do? By for which date? They have not given the expiry date, so XX date, okay. What rate did we enter? 20,000. Then I come back on that XX date, okay. I come back on that XX date, opposite. What is the Nifty on that date? This is of no use to me, okay. Because futures is what is critical. Because there is a separate market. There is a spot market and there is a futures market. In an ideal scenario, both should match. In an ideal scenario, both should match on the expiry date, but some difference will be there. That is called basis risk. That is technically called basis risk. I'll talk about this risk more when as I do more questions. So on the last date is 20,000, 805. I make a profit of 805. How many contracts did we do? 805 into 10. Profit is 8,050. Profit is 8,050. Any doubts on this? Okay, now I move to the next segment of the chapter, which is called hedging. Now, why did we learn this futures valuation? Futures has multiple purpose. One is called speculation. We are not bothered about the speculation. Speculation means he is speculating something will happen, and accordingly he is taking some position. If it happens that way, he makes money. If it doesn't happen that way, he is making loss. One is another purpose is arbitrage. What is arbitrage? Comparing a fair futures price with the actual futures price and then deciding whether there's an arbitrage opportunity or not. That is one type of a calculation. Third is hedging. What is hedging is, today I have 1 crore worth of shares. Today I have 1 crore worth of shares. This shares can fall down significantly in the next 5 days because budget is getting announced. Our election results are going to come. Election results can have a significant impact on my share price. So these are likely to go down or may go up also. Likely to go down or may significantly go up. If budget is very good, our election results are very good for the market, it may go up also. But I don't want to be impacted. One choice I was, let me sell all the share. Let me sell all the share. If I do that, I have to pay first brokerage, then short-term capital gain, long-term capital gain, all that comes into picture. So I don't want to sell. But I don't want this risk. I don't want this risk. That is where you will do something called as futures hedging. That is where you will do something called as futures hedging. How we do futures hedging? Security, beta, weight, product. Security, beta, weight, product. That format will give you the futures hedging calculation. How is it done? You will understand. Perfect hedging means I am doing perfect hedge means I don't want any risk. I don't want any risk. Hedging means protection against fall or increase in prices. Today I have 1 lakh shares of TCS. I bought them, okay. I want hedging against it. Go to the futures market and take an opposite position. Go to the futures market and take a opposite position. In the spot market, you have a buy. In futures, you should sell it. In the futures, you should sell it. What will you sell? 1 lakh shares of TCS there. 1 lakh shares of TCS in the futures market till how many days? Another 10 days. After that, I will remove the hedging. After that, I will remove the hedging. How is it done? Calculation all we'll see. But TCS is there in spot as well as in futures. But I bought shares of Bharadwaj Institute, which is not there in the futures market. So proxy for Bharadwaj Institute will be Nifty. Proxy for Bharadwaj Institute is going to be Nifty. We will use Nifty and do hedging. How is it done? Working and all, you will see it later. Working part, we'll see it later. But this is the format. Security, beta, weight, product. This format we will use to do the hedging. This is my third format. Security, beta, weight, product. First format, I told you to write spot price, rate of interest, dividend, storage cost, time period and compounding frequency. Second format, date, position, action, reference date and rate. Third format, security, beta, weight, product. Nothing beyond this. What are we going to do in the third format? You will understand as we proceed. If you want perfect hedge, beta is 0. Some question will not ask for perfect hedge. They'll give a beta. If they give a beta, what will happen? You will understand. So beta is equal to risk of security or market. Beta of market is 1 time. What is weight? Amount of purchase or sale of shares or futures. You can buy, you can sell. If you are buying something, it is positive. If you are selling something, it is negative. If you are buying something, it is positive. And if you are selling something, you will write it as negative. What is total of weights? When you put a total, no, you should not include this in the total. The weight of the Nifty. The weight of the Nifty will not come in the total of weights, but will come in the total of product. It will not come in the total of weights, but will come in the total of product. Now, what does this mean? Nifty, I wanted to buy Nifty worth 50 lakh rupees. So, I have taken risk of 50 lakhs. But to buy Nifty worth 50 lakh in the market, you need to just pay a margin money of 5,000 rupees or 50,000 rupees or 5 lakh rupees. Only a margin money needs to be deposited. If you want to buy a share, if you want to buy shares worth 20 lakh, you have to pay 20 lakh. Weight is the cash inflow or outflow, real cash inflow or outflow. Product is taking the risk. Product is the risk component. Weight is basically the actual inflow or outflow. If you buy a share, you will have an outflow of cash. If you sell a share, you will have inflow of cash. But if you sell futures or buy futures, you will not have outflow or inflow. You will not have outflow or inflow. That is why in the weights, you just need to remember that in the weights, I'll not put that in the total. I'll explain this as we proceed. As we do questions, you will get more clarity on this. Let me directly get into problem now. Let's come to question 20. BSE 5,000, value of portfolio 10 lakh 10,000, risk free interest rate 9%, dividend yield 6%, beta of portfolio 1.5, beta of portfolio 1.5. We assume that a future contract on the BSE index with what? 4-month maturity is used to hedge the value of portfolio over next 3 months. I want hedging only for 3 months. I should ideally take a 3-month contract. If you want hedging for 3 months, you should ideally take a 3-month contract. But you are saying, no, I will take a 4-month contract. I will take a 4-month contract. That's my wish. You cannot tell me no. I want to take a 4-month contract to hedge the portfolio for how many? 3 months. One future contract is for 50 times the index. Based on the above information, calculate price of future contract. First, do fair futures price calculation. Part 1, 4-month contract. Get me the fair futures price. Spot is 5,000. Put it in the format spot, rate of interest, dividend yield, do all that. Get me the fair futures price. Please do the fair futures price calculation. I'll explain after that. Get me the fair futures price. Guys, please do it. Please do it. Calculate the fair futures price. What's the spot price given? Rate of interest 9% per annum. Give me for 4 months. Time period. Dividend 6% per annum or storage cost. Compounding frequency once in 4 months. Fair futures price is spot price 5,000 into 1 plus 3% minus 2%. 1 plus 3% minus 2%, which is 5050, which is 5050. So value of one contract, right? Value of one contract is equal to 5050 into what is the lot size? 50 rupees lakh 52 500. I have done this. Okay, price of one future contract. Where is the hedging coming into picture? We'll understand. 252 500. Any doubts on this? Then the question is saying, what is the gain on short futures position if index turns out to be how much? 4,500 in 3 months. So I want to calculate profit or loss. I want to calculate profit or loss. Let me get into the profit or loss. At that time, hedging will come into picture. At that time, hedging will come into picture. Now write date, position, action, reference date, rate. Date, position, action, reference date, rate. Date, position, action, reference date and rate. Date, position, action, reference date and rate. Please write along with me. I know which questions I want you to do. Please write along with me. Date, position, action, reference date and rate. Now, question originally said that you want to hedge your portfolio over the next 3 months. Hedging may mean buying. Hedging may also mean selling. Hedging may mean buying. Hedging may also mean selling. There is some wording saying that short futures position, but let me analyze that separately now. Did I buy originally or sell originally? Did I buy originally or sell originally? Hedging will indicate that you have sold. Hedging will, sorry, short will indicate that you have sold. But let me check that now. Let me check that. So I have created this format. I'm leaving some 5 lines and coming down. Hedging action. Hedging action. Security, beta, weight, product. Very simple format. Security, beta, weight, product. Hedging action. Security, beta, weight, product. Security, beta, weight, product. Extremely useful format in derivatives. Security, beta, weight, product. First is portfolio. First is portfolio. What is the beta of my portfolio? How much is my portfolio value? Positive 10 lakh 10,000. Why positive? Because I'm holding that now. I am holding that. I have purchased it. I have purchased it. Multiply, get the product. 15 lakh 15,000. 15 lakh 15,000. Security, beta, weight, product. I'm going to hedge it now. I'm going to hedge it now. Hedge it through what? BSE futures. BSE futures, which have a beta of 1. BSE, Nifty or Sensex will have a beta of 1. Understand the format very clearly. Hedging means my overall beta is 0. Hedging means my overall beta is 0. Hedging means my overall beta is 0. Whatever you write here, it will not come in the total of the weight. Whatever you write here will not come in the total of weight. So what will be the total of weight? 10 lakh 10,000. 10 lakh 10,000. What will be the product for the overall? 0 into 10 lakh 10. 0 into 10 lakh 10. What should I write here so that total of this and this becomes 0? Minus 15 lakh 15,000. Minus 15 lakh 15,000. Minus 15 lakh 15,000. Minus means you are selling it. Minus means you are selling it. What should I write here so that 1 into this number is minus 15 lakh 15? Again minus 15 lakh 15. This means you should focus only on this weight number, okay? So it does not come in the total. For hedging my portfolio, I should sell BSE futures of rupees 15 lakh 15,000. To hedge my portfolio, I should sell BSE futures of rupees 15 lakh 15. Why sell? Because negative. Because it is negative. You will do this 3-4 times in few questions. You will get full clarity. You will get full clarity. Most important in weights total, 15 lakh negative will not come. Will not come. Now right below, we should sell BSE futures of rupees 15 lakh 15,000 to hedge our portfolio. Hedge our portfolio. We should sell BSE futures of rupees 15 lakh 15,000 to hedge our portfolio. Any doubts on this? It doesn't end here. Number of contract to be sold. Number of contract to be sold. 15 lakh 15. What is the value of one contract you calculated? No. 2 lakh 52 500. 2 lakh 52 500. Sometime back I told you to write. That is why this question I want you to write. I told you very clearly I want you. Some of you are not writing it. I don't understand why. I don't tell you to write every question. There are few questions where I know why I want you to write. 15 lakh 15,000 divided by 252 500. How many contract? So sometime back you calculated profit or loss where they clearly told that you sold 6 contract or 5 contract or 10 contract or 20 contract. Here they have not told you directly. You had to do this calculation. You have to do this calculation to identify that you have sold what? 6 contract. You have sold 6 contract. It doesn't end here. There is one more adjustment in the question. We have sold 6 contract. Any doubts in this? Any doubts in this? Can I proceed? Day 0. Day 0. Original. Day 0 original. My action was sell. My action was sell. I took this action for month 4. took this action for month 4. I don't know why I took 4-month futures contract, but that's what I taken. That's what I have taken. What was the month 4 futures price? Month 4 futures price on day 0. 50, which you have calculated. Now understand very clearly. This is very important. Day 0 spot 5000 futures 5050. We have come to what date now? Look at the part 2 of the question. We have come to what date? We have come only to 3 months, which is 4000. Index turns out to be 4500. Index turns out to be 4500. Futures will not be 4500. Futures will not be 4500. What will I do? Fair futures price is equal to spot price into 1 plus R minus Y into T. I'll have to do the calculation. I'll repeat again. Day 0 spot 5000 futures 5050. Day 90 spot is 4500. This is 120. If they had given day 120 price, spot futures both are same. Spot and futures both are same if they had given day 120 price. If they had given day 1, in fact, that also can change. In the MCQ which I did, I gave two different numbers. One 5 rupee difference was there. Only some 5 rupee difference was there. In case they give you day 120 index price, write it as futures. In they give day 120 futures price, write it as futures price. If they don't give day 120 and they give day 90, they give day 90. Now listen, fair futures price is equal to spot price into 1 plus R minus Y. Spot price now is 4500. R is only 1 month. What is the interest for 1 month? Point. What is the dividend for 1 month? Calculate now. Fair futures price. Complete this. I'll explain this. This covers a lot of things which I want to do. All the 3 formats are covered in this. Excellent problem. Everything is covered here. What is the number you get? Fair futures price. In this table, you can use only 4511. You cannot use 4500. Because question used the word index turns out to be 4500. If the question had used the word index futures turn out to be 4500, please use it directly. I have no problem. Index futures means please use it directly. But the wordings used in the question is what? Index turns out to be 4500 and not index futures turn out to be 4500. I would suggest you to write this table. Day 0 spot futures. This is the relationship. Day 0 spot was 5000, futures is 5050. Day 90, day 120 both will be same. Yes. We have assumed FFP to be the AFP. Able to understand this? Getting clarity on this? Every day as spot changes, futures will keep changing. One important rule is the gap between the two will keep going down as time passes by. The gap between the two, because we are basically following time value of money. Earlier I did time value of money for 4 months. Now I'm doing time value of money only for 1 month. The gap is only now 11 rupees. If you have done the calculation, your gap would have been 11.25. Gap would have been 11.25. This gap on the last day ideally should be 0. On the last day ideally should be 0, but practical world some 1 rupee, 2 rupee up and down will be there. Some up and down difference will be there. That is called basis risk. That is technically called basis risk. Any doubts on this? So I come to now day 90. This is how you should read the question, okay? Listen, day 0, so you should not write this. I'm writing here. On day 0, spot is at 5000. For that, the day 120 was 5050. For that, the day 120 was 5050. Now on day 90, spot is how much? No use of this 4000. I cannot directly use. Opposite by My question is on day 90, you should read it like this. On day 0, what is month 4 price? 5050. On day 90, what is day 120 price? On day 90, what is day 120 price? On day 90, what is day 120 price? You cannot write 4500. You cannot write for on day 90, what is day 90 price? 4500. On day 90, what is day 90 price? Spot price. Spot price is day 90 on day 90. But I wanted on day 90 what? Month 4, because this has to always remain same. These two has to remain same. You can cancel a month 4 contract with only a month 4 price. You can cancel a month 4 contract with only month 4 price. What is the number you told me? 45 negative. Negative loss per unit. Sorry, profit per unit. Profit per unit. Profit for 6 contract. That 6 is now useful. Profit for 6 contracts. Profit for 6 contract. This, what is the lot size we have? 50 into 6. Complete this, I'll explain again. This is kind of takes care of all the three. All the three are covered in this. All the three discussion points are covered. All the three formats are covered here. Some question can have normal rate and CCRFI rate both. Normal rate and CCRFI rate both. Let me explain. Normal rate can be converted into a CCRFI rate using something called as natural log tables. And CCRFI rate can be converted into normal rate using e power RT tables. For example, in this question, below the table you will see this natural log 1.1050 0.0998. This is there below the table. This is there below the table. That is normal cost is 10.5%. Normal cost is 10.5%. This normal cost can be converted into a CCRFI rate. Can be converted into a CCRF, because practical world no CCRFI exists. You go to a bank and ask, give me a loan. They'll give normal rate. They cannot give CCRFI. So we have something called as natural log tables, which can convert a normal rate into a CCRFI, and e power RT tables, which can convert a CCRFI rate into a normal rate. Now 10.5% is 1.105. 10% is 1.105. Now what is the use? Natural log 1.105, 0.0998 means normal rate of 10.5% is CCRFI 9.98%. Is CCRFI 9.98%. If you do e power 9.98%, you will get answer as 10.5%. You will get answer as 10.5%. That is e power 0.0998. I get 1.1050. I get 1.1050. So I can convert a normal rate into a CCRFI rate, CCRFI rate into a normal rate. No other question we did this. I don't have to do, because without natural log value I cannot do it. Without natural log value I cannot do it. In this question they have given the natural log value. They have given the natural log value in the question. They have mentioned below ln. ln is natural log, that is ln. ln is natural log 1.105 is equal to 0.0998. So R is not equal to 10.5%. R is equal to 9.98% CCRF. This is what it is. Original question by price increase plus into plus profit. Plus into plus profit. Original question by price decrease plus into minus is loss. Plus into minus is loss. Original question sell minus into plus is loss, and minus into minus. Minus into minus is the profit making situation. Minus into minus. So if you buy something, price should go up. If you sell something, price should go down. These two situations you make money. All other situation you lose money. You make money if buy price went up and sell price went down. Any doubts on that? Let's come to 31. A portfolio manager has the following 5 stocks in his portfolio. Assuming you gone through all of this, let's just start with this. This is the starting part. Beta is 1.17, weight is 10 lakh, overall is 11 lakh 70,000. Question has talked about changing the beta in part 2 and part 3. One is increasing the beta, one is reducing the beta, and there is another part which talks about Nifty futures, which I don't want to do. Nifty futures, we have already done so many questions. Let's do with risk-free security. Let's do with risk-free security. Now let's put security beta weight product, reducing beta to 0.8 times. reducing beta to zero point 0.8 times, portfolio risk-free security overall. This question is a very good problem. It will cover whatever I wanted to teach on increasing or decreasing through risk-free security. Portfolio given in the question 1.17, okay, 1.17, 1.17. Okay, now listen. Reducing beta, two things can happen. Today, I have a portfolio of 10 lakh rupees. One option is I bring more money. I bring more money. I don't want to touch the existing share. I don't want to touch the existing share. I am saying I'll bring extra money. I'll bring extra money. I don't want to touch the existing share. I don't want to touch the existing share. That is one answer. Second answer is like the last problem we did where we sold the share and got new thing. So first answer is alternative one, bringing fresh money. Bringing fresh money. That is what the wording question says. Question says how much risk-free investment could he bring in? How much risk-free investment could he bring in? You can also understand that as saying that no, I will bring in risk-free investment, but how will I bring? By selling the share. By selling the share. So alternative one is this. Parallelly, my alternative two is selling shares and bringing risk-free investment. Selling shares and bringing risk-free investment. Two options I have. Both will reduce beta. Both will reduce beta. First option, I don't want to touch my 10 lakh. I don't want to touch my 10 lakh, which is the shares. Uh, that's all. Once this is written, it's over. What is the beta of risk-free security? 0. Overall? 0.8. I cannot write this as of now, okay? I cannot write this because this is not like Nifty where you can say that it will not add up. But what I can do is, whatever it is, what will be here? 0. Total. If total is 11 lakh 70, what should be this? 1462 500. If this is 1462 500, 462 500. So I should bring in risk-free investment of 4,62,500. This is provided you can bring fresh money. This is provided you can bring fresh money, which may be possible, may not be possible. If I'm in need of money, I'll not be in a position to bring fresh money. I'll not be in a position to bring fresh money. Any doubts on the table? Everything will come only from the table. Just be very clear on the format, how you keep moving around the format. Second option, what I will do is my shares of 10 lakh will go down to what number I don't know. Whatever it goes down, I'll bring in risk-free investment. I will bring in risk-free investment. In short, my total will be 10 lakh. My total will be 10 lakh. That much money only I have. My total will be 10 lakh. That much money only I have. Same thing. Product is now. This is going to be 0. This has to be, if this has to be 8 lakh balancing figure, 683, and this is balancing figure 316 239. So if you're going for sale of share option, if you're going for sale of share option, sell 3,16,239 and bring risk-free investment. Bring risk-free investment. You do not want to go for sale of share option, which is also existing, which also exists. In that case, what you can do is you can just smartly just bring risk-free investment, which is 462 500. Is this a different portfolio? No. Both are same only. 10 lakh on 1462 500 is 68%. This is also 68%. The composition is 6832 6832. The composition is 68. 10 lakh on a base of 1462 500 and 4 lakh 62 on a base of 1462 500. The composition is 68 31 68 31. The composition remains the same, just that in one case I had the flexibility to bring more money. I had the flexibility to bring more money. Any doubts on this? Next, increasing beta. 1 point. Again, two things can happen. For increasing beta, two things can happen. First thing is I borrow money but don't buy more shares. I borrow money but don't buy more shares. Then what will I do with that money? I'm yet to decide. I have borrowed the money, but I'm yet to decide what to do with that money. I will not buy more shares. I will not buy more shares. Second option, I will borrow money and buy more. Why borrow? If you want to increase the risk, you have to borrow only. If you have to increase the risk, you have to borrow money. The format will automatically tell that. Format will automatically tell that. Now, I am not ready to buy more shares. I am not ready to buy more share. Why I am not buying? Because I feel these shares only this much is sufficient. Let's not put more money. Let's not put more money. Why am I borrowing? I'll use it for some purpose in few days. I'll use it for some purpose in few days. Then why am I borrowing now itself? That is what the question says, that you have to borrow. You have to borrow. So overall beta is what? 1.4. Weight will not be 10 lakh. Borrowing will be written as minus and weight will change. Weight will change. So we will write weight later on. This number is going to be what? This number I don't know, but this number is going to be 0. Total is 11 lakh 70. This number is 835 714. Format automatically gives that. It's a very simple format. Sell risk-free security or borrow risk-free security of 1,64,286. Please go to the market and borrow at risk-free rate, which is not possible as such. Borrowing at risk-free rate may not be possible, but we are doing calculation as if you are able to borrow. Negative means borrow. Negative means, see, in this format, positive means asset side of the balance sheet. Negative means liability side of the balance sheet. So if you are buying something, it will come in asset side of my balance sheet. If I'm selling something, I have to deliver that, it will go to the liability side of the balance sheet. It will go to the liability side. So whenever you're doing a short sell, we write minus because it is on the liability side of the balance sheet. Any doubts on this? Okay, you may ask, why did I borrow money then? Okay, that is the second option. By borrowing, I will increase my investment. With borrowing, I'll increase my investment. So in this side, 1.4, this 10 lakh will increase now, but overall total will be 10 lakh. Overall total will be 10 lakh. Like here, the overall total was 10 lakh. The same overall total is maintained. How will overall total be 10 lakh? You buy more shares, you borrow, both will net off each other. Both will net off each other. So product is what? 14 lakh. This is going to be 0. Balancing figure. 14. Balancing figure. Again balancing figure. I can keep doing any number of questions using the format. I can keep doing any number of questions using the format. There's no end to the number of questions we can do using the format. It is not anything new. So when you want to increase risk, you have two choices. When you want to increase risk, you have two choices. Better to do which approach I cannot say because I don't know what will be there in the ICA solution. Whichever works fine to you. Whichever works fine to you, you keep doing it. Write a note and then proceed it. And for reducing risk, some question will very clearly mention that you want to sell risk-free security. So you want to buy risk-free security by selling the shares. The last problem I did, that reducing the beta question specifically said that we have to sell shares. So if you have more money, to me more logical is in these two, alternative 2 is more logical, that is borrow and buy more share. But ICI sometimes have given alternative 1 answer also. I think the printed solution has alternative 1 answer. The printed solution has alternative 1 answer. That is, I'm borrowing the money. I'm borrowing the money and keeping it idle. I'm borrowing the money and sold is negative. You're getting no. You're getting the answer as negative, no. So negative is borrowing. Bought is positive. Sold is negative. Any doubts on this? Same thing you can do it through our beta calculation, which is a fairly simple thing. Any doubts on this? Okay, I come to the next part, the most important part again. Maybe, though I don't say that there's another format, but technically futures 3 formats and 2 more concepts are there. 2 more concepts are there. I come to the next concept, which is called net realization concept. Very important concept. Listen, whenever you enter into a futures contract, on 31st December, futures can only give you net settlement. Futures can only give you net settlement. Then what will happen to the spot buying or selling? You have to do only at the spot rate. You will have to do only at the spot rate. For example, I entered a contract at the rate of 60. I'll not be able to sell at 60. I'll not be able to sell at 60. I'll be able to sell only at the spot rate. Only at the spot rate. Then why did I enter into Nifty futures? You'll understand when I do the calculation now. You'll understand the calculation. A rice trader has planned to sell 22,000 kg of rice after 3 months from now. He wants to sell after 3 months from now, which indirectly means he has the rice today with him. He has the rice today with him, or he is going to get the rice in few days. He is going to get the rice in few days. Spot price is 60. 3 months is 59. So futures is basically what type of a market is this? Contango market or backwardation market? Backwardation. So somewhere market is feeling that price is going to crash down. Price is going to crash down. Size of the contract is 1000. The price can fall as low as how much? So I am worried that price can go down as low as 56. So I want to take the help of futures. I want to take the help of futures. So interpret the position of trader in cash market. Advise the trader position should he take in futures market to mitigate the risk of reduced profit. And what is the effective realized price? What is the effective realized price? My effective realized price will not be 59. My effective realized price will not be 59. Then what it will be, you will understand. What it will be, you will understand. It can be slightly up, slightly less. Slightly up and slightly less. That's the problem with futures. The problem with futures is you will not get the realization which you are wanting. You will not get the realization which you are wanting. You will get slightly more or slightly less, which is technically called as basis risk. Which is technically called basis risk. I'll explain the basis risk in this question. Now, right. The trader wants to sell 22,000 kg of rice 3 months from now. 3 months from now. Hence, he should enter into sell contract in futures market. Hence, he should enter into sell contract in futures market. Hence, he should enter into sell contract in futures. Why sell contract in future? Because after 3 months, I want to sell. After 3 months, I want to sell. This indirectly means that he has a long position in cash market or spot market. Long position in cash market or spot, because both of them will be opposite. Both of them will be opposite. There I want to sell, which means here I have bought it. Here I have bought it. This answers part 1 and part 2 of the question. Both are answered in this. Part 1 asked what? Interpret the position of the trader in cash market. I have a long position in cash market. What should I do in the futures market? Go ahead and sell 22,000 kg of rice in futures market. Is there any contract size, anything mentioned in the question? Okay, so contract size is mentioned. Number of contracts to be sold. 22,000. Instead of giving in rupee terms, they have given in kgs, which makes it more easier for us. 22,000 kgs divided by what? 1000 kgs. 22 contracts. 22 contracts. Now, the problem with our futures is ultimate realization will happen only at spot rate. Ultimate realization will happen only at spot rate, but there will be something called as a net settlement. There will be something called as a net settlement. What is the futures rate today? 59. My hedge is successful if I get 59. My hedge is successful if I get 59. I'll not get 59. I'll get slightly up or slightly down. I'll get slightly up or slightly down. Any doubts on this? Next, net realization. Net realization. Particulars and amount. Net realization or effective realization. Just use the word effective realization. Effective realization. Sell rice in spot market. After 3 months, I will sell it in the spot market. Tell me how much I'll get. 1 kg. Just give me 1 kg price. After 3 months, 57 per kg. 57 per kg. After 3 months, I will sell the rice at what rate? 57. Sell rice in spot market at 57. At 57. Any doubts on this? Clear? I sold it at 57. I sold it at 57 in the spot market. In the spot market. Then what was the use of futures? The use is this. Futures profit or loss. For that, come down date, position, action, reference date, rate. Date, position, action, reference date and rate. Date, position, action, reference date and rate. Futures cannot change this 57, okay? It cannot change this 57 because we do a net settlement. Your realization will happen only at the spot rate. Realization will happen only at the spot rate. So if somebody asks me what realization will I get in futures market fully, I cannot give an answer unless the 3 months get over. Unless 3 months get over. But one thing I can tell you is it is going to be closer to originally planned 59. It is closer to originally planned 59. We had originally planned 59 to be the rate. Now day 0. What position did we enter in futures market on day 0? Original sell month 3. 3 months down the line. 3 months down the line. At what rate did you sell? 59. You sold it at 59. You come back after 3 months. You come back after 3 months. You sold it at 59. You come back after 3 months. Opposite is what? Buy. In month 3, what is the month 3 futures price? In month 3, what is the month 3 futures price? Ideally, both should match. Ideally, both should match. If they are not matching, we have a risk called basis risk. We have a risk called basis risk. If both are not matching, we have a risk called basis risk. Ideally, both should match. Unfortunately, it is not matching. Unfortunately, it is not matching. What is the rate you said? 58. Put a total. Profit per kg. I'm doing calculation for only 1 kg. So my overall realization is 58. Overall realization is 58. Now, what is the utility of the futures contract? Now understand, because in Excel I can show you the calculation very fast. Listen, if on the last day, if these two had matched, spot rate and futures rate, I will get my 59. Spot rate and futures rate, if both had matched, I will get my originally planned 59. I'll get my originally planned 59. I'm matching them. I make a profit of 2 rupees. I'm adding it here. Listen, last day, unfortunately, rice is at 1 rupee. It has crashed down to 1 rupee. But if spot and futures match, I will get my 59. I'll get my 59. I change this to 1 rupee. I make a 58 rupee profit here. 1 plus 58, I get my 59. It touched 100 rupees. It touched 100 rupees. Still, I'll get my 59. Still, I'll get my 59. If both are matching, I lost 41 rupees. 100 minus 41, I get my 59. Where will the change happen? In case there is a difference. The difference can't be huge. The difference between the last day spot price and last day futures price cannot be very huge. So futures will ensure that you get a number closer to 59. You get a number closer to 59. If you want exact 59, then if this is 20, the below one also has to be 20. If this is 10, below one also has to be 10. Profit at one place, loss at one place, and you are offsetting and getting 59. Profit at one place. What is profit at one place? If you are selling at 100 rupees in the spot market, you are very happy now. You are very happy because you sold it at 100. But that's of no use. You sold at 100 there and you are suffering a loss of 41 rupees in the futures market. You are suffering a loss of 41 rupees in the futures market. You will get your 59 rupees provided both are matching. If there is even a small deviation, let's assume now I talk about a deviation. The deviation is 50 paise. Deviation is only 50 paise. Just give me a minute. There's a deviation of 50 paise. 100 there, 99.5 here. 100 there, 99.5 here. You will not get 59. You may get more, you may get less. You will not get 59, but still I'll get closer to 59. Still I'll get closer to 59. So my effective realization in futures is equal to spot realization. Spot realization plus or minus futures profit. Spot realization plus or minus futures profit. Able to understand this? Clear? I'll quickly discuss the last concept, which is on maintenance margin. Once I do this, I want to revise the entire futures because certain concepts I've done it at few places. I can revise them, all of them together. I don't want to revise now and then do maintenance margin. So let me close on maintenance margin also. Now listen, in a practical world, what happens is whenever you buy a futures or sell a futures, you don't pay full money. You don't pay full money. But futures are traded on a daily basis. We saw one problem where stock price went down by 6%. Futures also went down along with it. So I may suffer profit or loss on a daily basis. So broker will say, give me some margin money. Give me some margin money. What is margin money? It is a refundable deposit. It is a refundable deposit, but this margin money will keep going up or going down on a daily basis because of MTM, mark to market on a daily basis. Because of MTM, mark to market on a daily basis. That is, on daily basis I'll calculate the profit or loss. On daily basis I will calculate the profit or loss, and because of this what will happen is there can be a profit or loss on a daily basis. Now the initial margin and the maintenance margin, some question will say something like this: take 6%, take 8%, take 6% and take 8%, or take 12% and take 15%, take 10%. If nothing is mentioned, there is a formula for initial margin and maintenance margin. What is initial margin is, there will be something called as a daily absolute change. Let me read this question. Sensex futures are traded at a multiple of 50. Consider the following quotation of Sensex futures in the next 10 trading days. You have bought one Sensex Nifty futures on Feb 4. Average daily absolute change. What is average daily absolute changes? On an average, the change will be 10,000. On an average, the change will be 10,000. The formula for, now right, let's come to this question. Initial margin is equal to daily absolute change plus 3 times of standard deviation. Daily absolute change plus 3 times of standard deviation. What is the implication of 3 times is, it will ensure that 99.99% loss doesn't exceed this level. 99.9. Can it still exceed? Yes, because it's 99.99. It's because it is 99.99. Loss can still exceed this number. What is the daily absolute change in this example? 10,000 plus 3 into, what is the standard deviation? So if you want to buy this contract, I'll tell you to pay 16,000 rupees. I'll tell you to pay 16,000 rupees. That is an initial margin. That is a initial margin. What is the maintenance margin in the question? Now, what is the implication of initial margin and maintenance margin? I'll explain in a problem. I'll do the problem there. I'll explain the implication of this. 75% into 16,000. On a daily basis, we will calculate profit or loss, and after calculating the profit or loss, the margin balance will keep changing. The margin balance will keep changing on a daily basis, and it can lead to something called as a margin call. It can lead to something called as a margin call. Now write day. You may need 5, 6, 7 columns. Day, price. Copy from the question, day and price. Closing price. I don't need anything else. Okay. 4 to 2009, 3296.5. I don't need other prices, just the closing price. 3294.4. Just quickly copy them. These are the prices. Let me know if any number is wrong there. These are the prices which are given in the question. I've just noted them. When did we buy the contract? 4th Feb. Have they mentioned the price at which I purchased? No. So, no, not initial margin. Price. Have they mentioned the price? So, I assume I bought it at the closing price of 4th Feb. I bought it at closing price of 4th Feb, which means no profit, no loss in February 4. No profit, no loss on Feb 4. Next, profit slash loss. Profit slash loss. This is my buying price, okay? This is my buying price. What is profit or losses? If price goes down, I make a loss. And if price goes up, I make a profit. What is the contract multiplier? So listen, this price minus my purchase price into 50. I lose 105. I lose 105. Then next day price minus the previous day price. Every day we are calculating profit or loss. Next day price minus the previous day price into 50. Again loss. Again loss. Profit. Loss. Profit. This will keep going on. This will keep going on. Every day you will suffer a profit or loss. First day, what was your purchasing price? Compare it. Thereafter, previous day price. You keep seeing it with the previous day price. Margin balance, margin call, revised balance. Margin balance, margin call and revised balance. Every day you have to calculate profit or loss. Every day profit or loss needs to be calculated. I kept on calculating for all the days. What is the margin we paid initially? First day 16,000, no margin call, revised balance is 16. What is margin call? I'll explain. First day you deposited 16,000. Okay, now listen for 2 minutes and then we start doing it. This 16,000 goes down to 15,895. Goes down to 15,895. Listen, as long as it does not go below 12,000, I have no problem. If it goes below 12,000, there is a problem. What is that solution? I'll explain. As long as my maintenance margin is not breached, I have no problem. What is the maintenance margin? This is okay. No margin call. Closing balance is 15,895. Closing balance is 15,895. Next day, what is the margin balance after the loss? Minus 3,200. No problem. I have not breached 12,000. I have not breached 12,000. No margin call. I am at 12,695. Moment I breach 12,000, what happens? You'll understand. Next day, what happened? Moment you go below 12,000, you need to replenish back to 16,000. You need to replenish this back to 16,000 original value. You need to replenish back this to. So 16 became 15, 15 became 14, 14 became 13, 13 became 12,001 rupee. I will not tell anything. But moment you go below 12,000, you need to take it back to what? 16,000. So a margin call is there, 16,000 minus this. And I now reach 16,000. I reach now 16,000 again. I reach again 16,000. Next day, what will be the value? 16,000 plus 18,760. 18,760. No problem with this. No margin call. Next day again, where I'm at 18,575. No problem. As long as I am above 12,000, no issues at all. Again a margin call. Again a margin call because I have breached 12,000. I have breached 12,000. So I have to replenish this back to 16,000. What is my profit or loss of the contract? Just addition of all this. Just addition of all this. That's my profit or loss of the contract. Any doubts on this? See, you can understand profit or loss in two ways. One is just adding all the profit or loss. Adding all the profit or loss. So I do that calculation. 9,695 is my loss. Second way of understanding is I gave 16,000 first, gave this, gave this 3 amount I gave, and you are now giving me back only 16,000. You're giving me back only 16,000. So I gave 16,000 plus 4210 plus 54. This is pure cash flow understanding. People understand this only. They say don't do all this MTM and all, don't make me do. Tell me what money you took from me. 16,000 rupees, 4,210 rupees, 5,485 rupees. How much you will give me back now? You are giving me back 16,000 because margin account has the 16,000. This is a refundable deposit. This is a refundable deposit. This money will come back to you. Contract over, they'll give you back this money. If the contract is over now, you will get back your 16,000, whatever is there in the contract. It's not 16,000. If it is 25,000, you will get back 25,000. Any doubts on this? Clear? Okay, guys, please be in listen mode. So we did valuation, we did arbitrage, we did net realization, we did hedging, we did maintenance margin. Totally 5 types of question or 5 formats. Okay. First format is spot price, rate of interest, dividend, storage cost, time period, compounding frequency. That is my format 1. That is for doing valuation. That is for doing valuation. Then I have format 2, security, beta, weight, product. That is for calculating the maintenance, sorry, for doing the hedging, Third part, date, position, action, reference date and rate. That is to calculate my profit or loss which is arising out of a futures contract. What will I do with that? That plus the actual price. That plus the actual price is my net realization. That plus the actual price is the effective realization or the net realization which I am going to get. So futures price versus the spot price. There is a futures market separate. There's a spot market separate. Don't try to confuse them together and say that this is happening in spot, this is happening in futures. Leave it separately, analyze it separately. What is the use of spot price? Using the spot price, I can calculate the fair futures price. What is the use of actual futures price? Any buying or selling in the futures market will always happen at actual futures price. Actual futures price. What is the use of fair futures price? FFP can be taken as AFP if the problem is silent. FFP can be taken as AFP if the problem is silent. How do you value futures? Spot price into 1 plus R the whole power n, or spot price into e power RT. How do you calculate e power RT? 1 plus x by 1 factorial, x square by 2 factorial, x cube by 3 factorial. What are the formula adjustment? Adjustment because of dividend and storage cost. If dividend in rupees, adjusted spot price is equal to spot price minus present value of dividend income. If it's in percentage, R is replaced with R minus Y. R is replaced with R minus Y. Storage cost in rupees. Adjusted spot price is equal to spot price plus present value of storage cost. R is replaced with R plus S. Dividend yield computation. If you want to calculate dividend yield, you should calculate the average of the dividend yield for the tenor of your futures contract. Go ahead and calculate the average of the dividend yield. Format for computing: spot price, time period, rate of interest, dividend, storage cost and compounding frequency. This you can also use to do reverse working and get spot price. An example which is there, this is a reverse working example. What compounding frequency do I take? CCRFI word is there, e power value is there, daily compounding is there. Please go ahead and use continuous. If nothing is there and they say 1 month interest rate, do monthly compounding. 3 month interest rate, do 3 monthly compounding. 6 month interest rate, do 6 monthly compounding. Nothing is there in the question. Go ahead and do once in the time period or technically simple interest. Arbitrage gain and future strategy. I'll compare AFP with the FFP. Actual futures price greater than fair futures price. It's an overvalued scenario. Sell in futures market, buy in spot market, and my action to buy in spot market is to take a loan, and my gain is the difference between FFP and AFP. No sign, nothing needs to be attached. Difference between FFP and AFP. What is the implied risk-free rate? Normal risk-free rate plus the amount of arbitrage gain divided by the spot price into 12 by M into 100. Cost to carry is the difference between FFP as per formula minus the spot price given in the question. What is convenience yield? FFP as per formula, FFP as per question. Both are not matching. That's called convenience yield, which is called future value of convenience yield. Discount, you will get present value of convenience yield. Contango and backwardation market. Contango market means futures is more than spot. Backwardation market is futures is less than spot. The difference between the spot price and futures price is called basis. Difference between spot and futures is called basis. Negative basis is contango market. Positive basis is backwardation market. How do you calculate beta? SD of spot price divided by SD of futures price into correlation coefficient. Beta and change in price. What is the implication of this is any market change happens, my security may change more or change less. Percentage change in my security is equal to percentage change in market into beta, into the beta. Physical settlement means I'm getting the gold as a settlement. Net settlement means I'll get the net amount and then I can go ahead and buy the gold. Then I can go ahead and buy the gold. Net I'll get my value. Net I'll get my value. Whatever I'm needing, it will come either through physical settlement route or through net settlement through. Practical world, only we do net settlement. We do only, what is the format? Date, position, action, reference date and rate. Where date refers to the date on which you enter the contract. Position refers to either original or opposite. Action refers to whether you are buying first or selling first. Buy means sell will be the next one. Sell means buy will be the next one. If you are buying something, write this as negative because it's outflow. If you are selling something, write this as positive, inflow. So I'm selling at 5,000, sorry, I'm buying at 5,000 and selling at 5,600, I make a profit. Buying at 5,000 and selling at 5,600. These two dates have to match. The reference date has to match in the calculation. Perfect hedge means beta becomes 0. How do I calculate? Security, beta, weight, product. First write your portfolio where can be A, B, C, D, any number of security can be there. Last is Nifty futures. Last is Nifty futures where Nifty futures has beta of 1. Weight is balancing figure. In the total of the weights it will not come. Product total will also be balancing figure and automatically the sum will be calculated. So beta is equal to risk of security or market. Beta of market is 1 time. Weight is amount of purchase or sale. Purchase will be written as positive. Sales will be written as negative. In the total of weights is total of position in spot market. Futures purchase or sale will not be considered in weights total because there is no inflow or outflow happens when futures is bought or sold. We did that maintenance margin question where we were buying or selling. We did not pay the entire amount. We just paid the maintenance margin. Product is weight into beta. Hedging, if the question gives you a target beta, put it in the format and write the target beta and then close it. Put it in the format, write the target beta. We saw one question where they wanted 0.6, one question where they wanted 0.91. Put it in the format. Format will automatically give you the answer. You just do all these MCQs at home. You will get full clarity. Only the MCQ is sufficient to quickly revise this. So today, I'm not sure if time permits today. If you just revise the MCQ part, just the MCQ part, the entire segment of the chapter will get over. Hedging, if the question says protection of specified percentage, if you are telling me that you want protection of only 60%, my new beta is equal to existing beta minus 60%. Existing beta minus 60%. We did minus 50%, minus 100%, minus 120%. So he is targeting 120%. He is targeting 120%. Size of one contract. Size of one contract is always actual futures price. Is always actual futures price. We should ensure that AFP is used for finding size of one contract. FFP should not be used. FFP can be used as proxy only if the data on AFP is not available. It's just a proxy. It's just a proxy if not available. If not available. Modification of portfolio beta through risk-free investment or borrowing. You can again put it in our format. Risk-free security will carry 0 beta. Risk-free security will carry 0 beta. When you are doing modification, two things can happen. If you are reducing the beta, you may bring in risk-free investment. You may bring in risk-free investment without sale of share. Or you may bring in risk-free investment with sale of share. You may borrow money, buy shares. You may borrow money and not buy share. Again, just one example you do, you will get full clarity on what we are doing. Here I have given the reason. I have given what you are going to do. You are not planning to sell shares and bring in additional money. That I have clearly mentioned because I cannot give so many options in the MCQ. So I have clearly mentioned what we are going to do. Otherwise, you have to write a note. Normal rate can be converted into CCRFI. CCRFI can be converted to normal rate using natural log. Using natural log, you can do the conversion of normal rate into CCRFI, CCRFI into normal rate. If you have bought something price went up, plus into plus, profit. If you have sold something, price went down, minus into minus is profit. Bought, price went down. Sold, price went up. Both are problem. Both are problem for me. Effective realization. Effective realization is realization as per spot rate. Realization as per spot rate plus or minus net settlement in futures. Net settlement, date, position, action, reference date and rate. I'll wait exactly for 2 minutes. Give me answer to this. Do the format. Do the format. What will be the spot realization? What will be the spot realization? First tell me. 25. Spot realization will happen at 25. I entered into a contract to sell at what? 21. Opposite contract at what rate? Negative 25.1. Loss of 4.1 added another 25. Loss of 4.1 added with 25. I get 20.90. I get 20.90. The MCQ will automatically take care of the concept which we are doing. Initial margin and maintenance margin. Initial margin is the amount to be deposited by buyer with the broker for entering into futures. This is like a refundable deposit. This is like a refundable deposit. Maintenance margin will be lower than initial margin, and we should ensure that balance in maintenance margin do not go below the balance in margin account do not go below the maintenance margin. If it goes below, then broker will make a margin call and you'll have to replenish this back to what? Initial margin. You'll have to replenish this back to initial margin. We are also allowed to withdraw money from margin account. We are also allowed to withdraw money from margin account if the balance in margin account is more than initial margin. So amount withdrawable is balance in margin account minus the initial margin. The initial margin can be a specific percentage or daily average change plus 3 times of standard deviation. Plus 3 times of standard deviation. Can you give me the answer to this? What is the initial margin? 80,000. Did we make a profit or loss here? Loss. How much loss? So 80,000 will go down to 60,000. 80,000 will go down to 60,000. Tell me what will be the answer to this? $8,000 plus 3 into 4,000. 3 into 4,000. What will be the answer to this? You'll have to replenish it back to initial margin. What will be the answer to this? I don't need any replenishment. What is the answer according to you on this? Anything above initial margin can be withdrawn. Anything above initial margin can be withdrawn. You can withdraw the entire amount also. But he's withdrawing how much? 60% of the allowed withdrawal. So this is 50,000. This is at 70,000. So extra 20,000 is there. I go ahead and withdraw 12,000. I go ahead and withdraw 12,000. Return on investment in futures. What is return on investment in futures? When you do a futures contract, there is an initial margin to be paid. There is a initial margin to be paid. Apart from the initial margin, sometimes some brokerage or commission will be paid. Return on investment is very simple. What I get back divided by what I invest into 100. So my investment is margin deposited plus brokerage or commission. Brokerage is part of investment as well as expense. Brokerage is a expense. Margin money is a refundable deposit. Why is it coming at both the places? Because this is paid on day 0. Brokerage is paid on day 0. That is why it is coming as part of my investment made. There is one MCQ, one example, one problem is there. When you do at home, you'll understand. What is the profit? Profit on futures position, any opportunity cost, any brokerage expense, and you get the ROI, which is profit divided by investment into 100. Only thing I want to tell you is, in investment, brokerage will be considered. In profit calculation also, brokerage will be considered. In investment, it will be considered. Even in your profit calculation, it will be considered. Is this really an investment? No, this is an outflow on day 0. What is investment? Is outflow on day 0. Asset swap. This is the last part of the futures calculation. What is asset swap is, I entered into a swap arrangement. What is swap arrangement? You give me something, I'll give you back something. That is a swap arrangement. Swap arrangement is you have to give me something, I'll give you something. Some people will enter into an asset swap. What is asset swap is, I'll pay you 2%. You should pay me whatever the return Nifty is giving. For example, ABC Limited has entered into a swap arrangement on a notional principle of 200 crores. I will pay you 1% per quarter. And receive what? Quarterly return of Sensex. Unfortunately, that quarterly return of Sensex can be negative also. That is, the amount which you want to receive is negative and the amount which you want to pay is positive. So here I have entered into an arrangement where you will pay me 1% and ABC Limited will pay 1% per quarter and receive the quarterly return of Sensex. How much is the return of Sensex here? Percentage. 5%. So what ABC is saying, I will pay you 1%. You give me 5%. I'll pay you 1%. You give me 5%. Net, you pay me 4%. Net, you pay me 4% on 200 crores. I will receive 8 crore. It can happen the other way around. I have to pay you 1% and you have to pay me minus 2%. How minus 2? Because Sensex gave negative return. I have to pay you 1%. You have to pay me minus 2%. Net, the difference is 1 minus of minus 2 is plus 3%. 1 minus of minus 2 plus 3%. You do this question at home, you will understand. Sensex return. There's a negative Sensex return also. The Sensex return can be negative. The Sensex return can be positive. When it is negative return, one party will enjoy a lot because they were to receive a negative amount and they were to pay a negative amount and receive a positive amount. So it will be a huge return for them. That is called asset swap. That is technically called asset swap. I'll move to the discussion options. In options, we have something called as basics. Then second segment of the option will focus on something called as calculating profit or loss. And the third segment will focus on valuation. In valuation, I'll cover all models except for one model called Black-Scholes model, where I'll tell you what I will do and accordingly I'll give you some indication, and there is a video which is uploaded in YouTube which can kind of take care. Otherwise, Black-Scholes model takes away a lot of time. I'll explain the model, everything. So first, let's understand what is option. An option contract is one where I get a right but not a obligation. That is, you entered into a contract to buy gold at the rate of 5,000. If prices are favorable, buy at 5,000. If prices are not favorable, don't buy at 5,000. You have a choice. You have a choice for this. So when we did net settlement, no, we got profit loss. But if it's an option, you will have only profit. You cannot have loss. You cannot have loss because you will say you don't want to fulfill the commitment. You will say you don't want to fulfill the commitment. So there are two types of option: a call option and a put
Sir,
option.
I think you're muted.
Sorry, there are two types of option. There's a call option and a put option. A call option is something which can be exercised at any point of, sorry, a call option is something which gives you a right to buy but not an obligation to buy. A put option gives you a right to sell but not an obligation to sell. So if you are planning to buy something, think about call option, and if you're planning to sell something, think about put option. Buying something, call option; selling something, put option. Call option is for buying something, put option is for selling something. In this also we have another two types of option. One is called as the exercise of an option can happen at, there is an American option, there is an European option. American option can be exercised at any point of time. European option can be exercised only on the expiry date, only on the last date. There are two parties to the option contract: holder or buyer. The other name for holder is buyer, who gets a right but not a obligation, who gets a right but not a obligation. Seller, a writer who gives you this right, who gives you this right. Indirectly, if you want to become a buyer of the option contract, you need to pay insurance premium. You need to pay insurance premium. What is the use of insurance premium? If something happens to my bike, the premium will help me. If nothing happens, the premium is gone. So the same is the option premium. Same is the option premium. You need to pay the option premium to the other party. You need to pay option premium to the other party. What will happen with the option premium? The other party, it is an income for him. If anything happens wrong in the option contract, that is if things don't go right, you will enforce it and earn some money out of it. You will enforce. Now understand this very clearly. Call option, a person who buys the right to buy. A person who buys, call holder. Holder is a person who buys something. Because somewhere people think holder means call option. No, holder does not mean call option. Holder means a person who buys something. Person who buys something. You can buy the right to buy. You can buy the right to sell. You can sell the right to buy. You can sell the right to sell. Right to buy is a product. Right to sell is a product. Right to buy is a product. Right to sell is a product. I can buy the right to buy. I can buy the right to sell. I can sell the right to buy. I can sell the right to sell. Who buys the right to buy? Tell me now. I'm asking you a simple question. Call holder. Call holder buys the right to buy. Sells the right to sell. Sells the right to sell. Put writer sells the right to sell. Buys the right to sell. Put holder. Again, listen. Buy, listen. Buy, sell is the first word, okay? If you are buying something, you are holder. If you are selling something, you are writer. You are buying something, you are holder. You are selling something, you are writer. If it's a right to buy, if it's a right to buy, it's called a call option. If it's a right to sell, it's called put option. For example, you see the word right to buy, it is a call. You see the word right to buy, it is a call. You see the word right to sell, it is a put. You see the word right to sell, it is a put. You are buying, holder. You are selling, writer. You are buying, holder. You are selling, writer. Clear? Any doubts on this? Now, exercise of an option. What happens is, in every problem, we need to decide whether an option is getting exercised or not, and that will decide the profit or loss. Only the holder can decide whether he wants to exercise or not. If you are a writer, you cannot tell that I don't want to exercise. You don't have a choice. The guy who buys the option will only have a choice, and he will decide whether to exercise the option or not. So every problem, when I ask, do you want to exercise or not, you have to think you are the holder. You have to think you are the holder. You could be the writer in the question. You could be the writer in the question, but decision on exercise is only taken by the holder. Option will always be exercised by the holder. If an option is exercised, there will be a net settlement. There will be a net settlement, and if net settlement happens, it is a loss for the writer and is a profit for the holder. Loss for the writer, profit for the holder. Holder will have limited loss. What is the limited loss? Insurance premium. What is unlimited profit? If anything happens to my vehicle, I'll get huge 50 lakh rupees or 50,000 rupees, but I pay a premium of only 1,000 rupees. So holder has limited loss, unlimited profit. Writer has limited profit but unlimited loss. Let's understand this. Purchased a 3-month option with a premium of rupees 30, exercise price of 550. Purchased a 3-month put option. Both I have purchased. Both I have purchased with a premium of how much? 5, exercise price of 450. Price on expiry date is 600. On the last day it is 600. Now if it's a call option, you need to ask a question. Do you want to buy at 550? Exercise price is 550. Do you want to buy at 550 when the price in the market is 600?
Yes.
Do you want to buy at 550 when the price in the market is 600?
Yes.
Yes, you will get 50 rupees profit. You will get 50 rupees profit. Do you want to buy at 550 when the price in the market is, your buying will happen at exercise price. Your buying will happen at exercise. Do you want to sell at 450? Do you want to sell at 450 when the price in the market is 600? No. So put option will lapse. Call option will get exercise. Put option will lapse. Call option will get exercise. On the call option, I will get 50 rupees. Okay. But I have to pay 30 rupees premium and another 5 rupees premium. I have to pay 30 rupees premium and another 5 rupees premium. So I'm paying 35, receiving 50, 15 rupees profit into 100. Into 100, I have a profit of 1,500. I have a profit of 1,500. Exercise price of put option 1,000. Price of underlying asset on expiry date 800. Premium received or paid on put option 45. How much is the net of payoff of put writer? Don't see the word writer. Just see the word put. Just see the word put. Now I need to ask a question. Do you want to sell at 800? Do you want to sell at 800? So, sorry, do you want to sell at 1,000? Do you want to sell at exercise price? Do you want to sell at 1,000 when the price in the market is 800? Yes. 200 rupees will be the gain for the holder and loss for me. I am the writer. Loss for me. I am the writer. But I'll be getting a premium of 45. I'll be getting a premium of 45. So I suffer a loss of 155. I suffer a loss of 155. Question is very simple. Do you want to buy at the exercise price when the price in the market is so much? Do you want to sell at the exercise price when the price in the market is so much? That is a question you have to ask in your mind. That is a question you have to ask in your mind. When can an option be exercised? Option can be exercised only on expiry date as European option. At any time is called American option. What is the use of exercise price? Exercise price is the price at which buying or selling will ultimately happen. Price at which buying or selling will ultimately happen. In market, you have so many exercise price. You can go to the market and find different exercise price. There are 3 types of option. In the money option, which are likely to be exercised. In the money option are those which are likely to be exercised. If I ask you a question and you say answer is yes, it is in the money option. If I ask you a question and you say no, answer is out the money option. And if you say I'm okay, yes, no, that is called indifferent, which is called at the money option, which is called at the money option. Example, current market price is how much? Exercise prices. Do you want to buy at 450? Do you want to buy at 450 when the price in the market is 400? Do you want to buy at 450 when the price in the market is 400? No, out the money option. No means it is a out the money option. Do you want to buy at 450 when the price in the market is what? 400. You said no, it is out the money. Answer is out the money option are those which won't be exercised, which won't be exercised. Now, if prices are likely to increase in the market, if prices are likely to increase in the market, I want to restrict my purchase price. I want to restrict my purchase price. Prices are going up in the market. Prices are going up in the market. I don't want to pay more. I don't want to pay more. You can do that by buying a call option. You can do that by buying a call option. Call option will restrict your maximum purchase price. Call option will restrict your maximum purchase price. That is, today Nifty is going up. If I buy a call option, I will not pay more than the exercise price. I will not pay more than the exercise price, because I'll ask you a question. Do you want to pay 20,000, which is today's price, when the exercise price is 18,000? So something like that, we'll ask a question, and accordingly what will happen is, if price starts going up, call option will come into picture. So long call will help when prices are expected to increase. Opposite of long call is short put. Opposite of long call is short put, and other side is long put if prices are likely to decrease. If prices are likely to decrease. Now, why is this short and long both are there? You can go for a long option, you can go for a short option. See, a writer is basically trying to find those option which will lapse. A writer wants the option to lapse. A holder wants the option to be exercised. A holder wants the option to be exercised. I will become a writer if I want to take more risk. I will become a writer if I want to take more risk with limited profit. More risk with limited profit. But 90% of the time writer will make money. 10% of the time only holder will make money. But whenever you make huge profit. He makes very limited profit. That's the game of probability. People will make huge money or only 10% chance. 90% of the chance writer will only make money. Writer will only make money. What is the money? Premium income. Premium income. Now, just to give an example, today price is 100. It will increase to 125. Excise price is 110. Do you want to buy at 110? Do you want to buy at 110 when the price in the market is 125? Yes. So long call will get exercised. A call will get exercised when price is going up. Do you want to sell at 110? Do you want to sell at 110 when the price in the market is 125? No. Short put will lapse. I'm very happy about it. I want the put option to lapse. I want the put option to lapse so that I earn the premium income. So that I earn the premium income. Clear? Any doubts on this? Clear? Next, intrinsic value and time value. Intrinsic value and time value is very simple. If you say option will be exercised, if you say option will be exercised, there is an intrinsic value. If you say option will not be exercised, zero intrinsic value. Zero intrinsic value. Wherever you say option is getting exercised, there is an intrinsic value. Wherever you say option is not getting exercised, you have zero intrinsic value. The option premium will be higher than your intrinsic value. Intrinsic value is the real worth. Intrinsic value is the real worth, but your premium will be higher than the intrinsic value. Will be higher than the intrinsic value. What is the gap? Gap is called time value. Gap is called time value, which depends on the time period. Higher the time period, higher the time value. Lower the time period, lower the time value. Example, exercise price is how much? Current market price. Tell me what is the, will the call option be exercised here? In this example, ask the question in your mind and tell me, will the call option be exercised? Somebody thinks no, please let me know. You may think a no also. Will the call option be exercised? The question is very simple. Do you want to buy at 1000 when the price in the market is 1200? When the price in the market is 1200, answer is yes. Intrinsic value is 200. Difference. Do you want to sell at 1000 when the price in the market is 1200? No. Answer is no. Intrinsic value is 0. No negative and all. No negative and all. Excise price of option is 1000 and 1100. Excise price of option is 1000 and 1100. Premium is 200 and 175. What is the nature of the above option? What is the nature of the above option? Now, I'll explain. The concept is yet to be explained. I'll explain the concept. Now, listen. Do you want to buy at 1000 when the price in the market is so much? Is a question. Do you want to buy at 1100 when the price in the market is so much is the second question. If it's a call option, my question is, do you want to buy at this price or do you want to buy at the higher price? What they are saying is, for a 1000 rupee option, my premium is 200, and for 1100 rupee option, my premium is, in call option, as exercise price goes up, in call option, as exercise price goes up, my purchase price goes up. As exercise price goes up, my purchase price goes up, which I don't like. So premium has to go down. Premium has to go down. As my exercise price starts going up, I want the premium to keep coming down. I want the premium to keep coming down. I'll explain again. In a call option, our exercise price going up means increase in buying price. Increase in buying price, which I don't like. I don't want my buying price to increase, but I want my selling price to increase. So practically what happens is, if you will see that these are different strike prices in the practical world. 2950, 21,000, 21,050, 21,100. These are the strike prices, and this is the premium. This is the call premium. This side, as price increases, the call premium is going down. Last traded price. Last traded price is the call premium. As exercise price goes up, call premium will go down. On the other side is the put premium. On the other side is the put premium, which will, you see the put premium as price is going up, you see put premium going up. As you see, put premium will go up. Put premium increases with increase in strike price. Call premium decreases with increase in strike price. Call premium, reason is very simple. In a call option, increase in strike price is bad for me. Increase in strike price is bad for me. I want to pay lower premium. I want to pay lower premium. In put option, increase in strike price is good for me. Increase in strike price is good for me. I'm ready to pay higher premium. In this example, premium is, sorry, price is going up, premium is going down, which is an example of a call option. Which is an example of a call option. Tell me what is the intrinsic value of this first. Tell me what is the intrinsic value in this. Tell me the intrinsic value first. Do you want to sell at 100? Do you want to sell at 100 when the price in the market is 80? Yes, intrinsic value is 20 rupees. Intrinsic value is 20 rupees. How much you are paying for the put option? 45. The difference is time value. The difference is time value. 45 minus 20. 45 minus 20. What is the utility of a call option? Call option will restrict my maximum purchase price. Call option will restrict my maximum purchase price. When you believe prices are likely to go up, you take a call option so that you put a cap on your purchase price. So that you put a cap on your purchase price. What is the utility of put option? When prices are going down, when prices are going down, you want minimum selling price. You want minimum selling price. Let's take an example. You plan to buy shares of TCS. Current market price is how much? You currently don't have money and also intend to pay a maximum of what? 5% more than the current market price. I don't have money with me now, but I don't want to pay more than 1050 for TCS. But what can happen in the practical world? The TCS can go to 1100, 1200, 1300, 1400, 15. I cannot put a stop there. I cannot put a stop there. But my point is very clear. I don't want to pay more than 5%. I don't want to pay more than 5%. How can I do? Buy a call option of 1050. Buy a call option of 1050. That will give you protection. That will give you protection. Just give me a minute. Okay. Now I directly get into the payoff calculation so that you understand it better there. Basics part 4 of the chapter. It is just to get started. You can read them later at home. Nothing. I'm not going to do any question because I've done them in the MCQs. I've done that in the MCQs. Come to 47. Come to 47. Go through the question. Okay. Let me look at this. A September option on AB Corp at a strike price of 130 is available at a call option price of 10. What is call option prices? This is the premium. Call option price is the premium you need to pay. Contract size is 100. Price today is 140. Price can range anywhere between 110 to 160 on the maturity with intervals of how much? 10. I want the payoff for call holder, call writer. A payoff for call holder and call writer. That is, what is the profit call holder will make, what is the profit call writer will make. This will set the basics clearly to you. So that's why we are doing this question. This type of question will not come in exam. This is just to set the basics right. Let's do payoff calculation. Payoff calculation. Payoff calculation. There is no heading per se. Exercise price is the first item. There are no headings to this. Okay, exercise price is the first row. Sorry, current market price is the first row. Current market price. Current market price is the first row. Current market price is the first item. The price can range from where to where they mentioned. 110 increases by how much? 110, 120, 130, 140, 150, 160. Price can range from 110 to 160. What's the exercise price? 1. I don't want to know whether I'm a holder or a writer till now, okay? Please don't tell me whether you're a holder or a writer till this. Unnecessarily, you'll complicate things by looking at holder or writer. I don't want to know at this point of time. Type of option. Tell me, is it call or put? Call. Action. That is, action is, will it lapse or will it get exercised? Will it lapse or will it get exercised? That is the point I need to write here. Will it get exercised or will it get lapse? Okay. I ask a question. Do you want to buy at 130 when the price in the market is 110? No, lapse. Do you want to buy at 130 when the price in the market is 120? Lapse. Do you want to buy at 130 when the price in the market is 130? Indifferent, technically lapse. Do you want to buy at 130 when the price in the market is 140? Answer is exercise. Do you want to buy at 130 when the price in the market is 150? Exercise. Exercise. Then comes GPO. GPO, if it lapse, it is 0. If there is a lapse, it is 0. And if you exercise it, it is the difference between current market price and exercise price. No sign as of now. No sign as of now. The difference is how much? 10, 20, 30. I'll come to sign in some time. Okay. I'll come to sign in some time. Premium. How much the premium we have to pay? Again, I'll come to sign in some time. Premium is 10. Okay. Now I'll come to the sign. If you are a holder, this is your profit. This is your profit. And if you're a writer, this is your loss. If you're a holder, the GPO is your profit. And if you're a writer, GPO is your loss. GPO is your loss. We are a holder or a writer here. Holder, I leave it as it is. If you are a holder, premium is your expense. Premium is your expense. And if you're a writer, premium is your income. So this is not 10, this is minus 10. Attach minus everywhere. Minus 10. And put total NPO. NPO is net profit. 0 plus minus 10, 0 plus minus 10, 0 plus minus 10, 10 plus minus 10, 20 plus minus 10, 30 plus minus 10. Any doubts on this? I'll again repeat. Till this point, please don't look at whether you are a holder or a writer, because that is where you confuse yourself. You ask wrong question and confuse yourself at this point of time. I have done this for a call holder. I'll do one more question for a put writer. Call holder is this calculation. Opposite is call writer. So I don't want to repeat that. I don't want to repeat that. Now, if you see, he has limited loss but unlimited profit. 0, 10, 20, 30, 40, 50, 60. It will keep going up. It will keep going up. So this is how the graph will look. The profit will keep going up like this. It will keep going up like this. You can keep making unlimited profit. This is for a call holder. This is for a call holder. Any doubts on this? Let's come to 48. Go through 48. Okay, what we are going to do, same format. Okay, same format. Be in listen mode only. I think you will unnecessarily waste time writing this. Be in listen mode. What are the prices the question has mentioned? From what to what? 90 to 90, 100, 110, 120, 130, 140. What is the exercise price? What is the type of the option? I'm not asked holder writer. Don't get into it. Okay. Type is put option. Do you want to sell at 110? Do you want to sell at 110 when the price in the market is 90? Exercise. Do you want to sell at 110 when the price in the market is 100? Do you want to sell at 110 when the price in the market is 110? Do you want to sell at 110 when the price in the market is 120, 130, 140? Exercise means the GPO is the difference. Lapse means it is 0. Exercise means the difference in the 90, 110, no sign. I'm not attaching any sign as of now. I'm not attaching any sign as of now, just the difference. Just the difference. What's the premium given in the question? Now I'm doing for a put writer. I'm doing it for a put writer. For a writer, I'm not, it's the word is not put. More important is writer. For a writer, this is negative. For a writer, this is negative because this is a loss for him. This is loss and premium is his income. Premium is his income. For a writer, GPO is a loss and premium is his income. I just put a total. Minus 10, 0, 10, 10, 10, 10. So the if you keep going downwards, that is price becoming 80, 70, 60, the writer will suffer huge loss. The writer will start suffering. For example, if price was 60, GPO will be minus 50. GPO will be minus 50. Premium is 10. Loss is minus 40. So a put writer or a writer will make limited profit, unlimited loss. Limited profit and unlimited loss. Any doubts on this? Any doubts on this? Now, I'll show the ICI question, which is simplest of the lot, which is going to be simplest of the lot. I don't know why they asked this question. This comes for 8 mark in exam. Look, read the question. 50, 50, 50. Go through 50. Go through question 50, guys, please. They want the net payoff for a call option holder and a put option holder. So you'll have to do call holder calculation, put holder calculation. I'll wait for 2-3 minutes. Same format. Please start doing it. Price is 200, 210, 220, 230, 240. Call holder separately, put holder separately. That will be clubbed together at some stage, but as of now, call holder separately, put holder separately. Put a table in this format. Till you write GPU and premium, don't look at whether you are a holder or a writer. After that only, please look at, because students keep making mistakes here. What are the price range they have given? 200, 210, 220, 230, 240. Exercise price 220. First type is call. Holder, writer, will see it later. Do you want to buy at 220 when the price in the market is 200? When the price in the market is 210? When the price in the market is 220? When the price in the market is 230? Lapse is 0, 0, 0. Excise is difference 10 and 20. What's the premium of the call option? Are we holder or writer? Holder, this is plus, this is minus. For a holder, premium is minus, so minus 6. So 0 minus 6. Clear? Any doubts on this? This is for a call holder. This is for a call holder. Then I repeat the calculation. Type of option is put now. Do you want to sell at 220 when the price in the market is 200? Excise. Do you want to sell at 220 when the price in the market is 210? Do you want to sell at 220 when the price in the market is 220? Gross payoff is difference. Premium is how much? Okay. Now, question has asked for what is gainful exercise level. What is gainful exercises? You can exercise an option but still suffer a loss. You can exercise an option but still suffer a loss. Example, if this was 221, if this was 221, do you want to buy at 220 when the price in the market is 221? Do you want to buy at 220 when the price in the market is 221? Yes. Answer is yes. GPO is 1, but I'm still suffering a loss. I'm still suffering a loss. So there are two types of exercise. One is exercise, another one is called gainful exercise. In this situation, exercise has to happen. There's nothing wrong in that. What is gainful exercises? My ultimate profit is at least 0 rupees. My ultimate profit is at least 0 rupees, which is this is 0. This is minus 6, so that I at least earn a GPO of 6 rupees. I at least earn a GPO of 6 rupees. When will I earn GPO of 6 rupees? If the price is 226. If the price is 226. So anything above 226 is a gainful exercise. Anything above 226 is a gainful exercise. Anything above 220 is a normal exercise. Exercise has to be done. If you exercise, your loss will go down from 6 rupees. Your loss will go down from 6 rupees. What is gainful exercise? Is making profit. Gainful exercise is making profit. When I come here, my NPO should be 0. Premium is minus 5. So I need a GPO of at least 5 rupees. I need a GPO of at least 5 rupees. Tell me at what price I'll earn a GPO of at least 5 rupees.
Sir, in the second thing, it is put option, no? Then GPO will be minus 1.
Friend, I cannot keep repeating. Okay, there's a doubt in live online. Why do you say GPO is negative for a put option, friend? GPO is depend on whether you are a holder or a writer. It does not depend on whether it is a call option or a put option. I have told so many times, but students keep making that mistake. It is on the holder or writer. The GPO can be positive or negative. Call option or put option cannot make GPO positive or negative. Clear? So I need 0. Premium is minus 5. Tell me when will I have GPO of 5 rupees?
Okay, sir. Okay.
2. It is not 225. If it's 225, I'll ask you a question. Do you want to sell at 220 when the price in the market is 225? You will say no. GPO will become 0. GPO will become 0. Do you want to sell at 220 when the price in the market is 215? Answer is yes. Answer is yes. For put option, you have to move in this order. For call option, your break even will be in this order. Call option break even will be in this order. If I put a proper graph, no, wherever you get 0 profit, 0 loss is the gainful exercise level or break even price. Is the gainful exercise level or break even price. I can give a formula, but I don't want you to remember the formula. Formula is very simple. Break even price for a call option is exercise price plus premium. And for this, it is exercise price minus premium. Exercise price minus premium. I don't remember formula. I don't want you to remember the formula. Understand the logic very clearly. Understand the logic very clearly. Now let's evaluate the third situation. Mr. A is holding 100 shares of VCC Limited. I'm holding 100 shares of this company. I want to protect what? Downside risk, because I want to sell them after 3 months. What position should I take in the option market to hedge my holding? See, I want to sell my share after 3 months, but I don't want the price to go down. There are two requirements you can have. One is called maximum purchase price. Second is called minimum selling price. If you want to buy something, you want to restrict your purchase price. If you want to sell something, you need minimum selling price. You need minimum selling. Which option will give you minimum selling price? No, writing and all later. First tell me which option will give you. Put option, and no writing. You have to buy the put option. You have to buy the put option. Writing doesn't give you any protection. Writing gives protection to the other party. Writing gives protection to the other party. Writing is not giving you protection. Writing will give you protection only to the other party. You don't earn anything. Insurance premium, insurance company will have loss only. They cannot have profit whenever you put a claim. So writing a put option or writing a call option gives you zero protection. Protection can only come by buying a put option or buying a call option. To cut it short, if you want to buy something, please buy a put option. And if you want to sell something, please buy a, if you want to buy something, buy a call option. And if you want to sell something, buy a put option. Put option, minimum selling price. Call option, maximum purchase price. Call option, maximum purchase price. Put option, minimum selling price. I can go for buying the put option. I can go for buying the put option. Good morning, friends. Good morning, friends. Okay, let's get to now revision of options first, and then I get to the option valuation part. Valuation will not take much time. It's a very simple area. Certain models need to be discussed there. One important model is there is Black-Scholes model, which we will learn it in a simple manner. Now, what we learned in option is I get a right but not a obligation. I get a right but not a obligation. If I have a right to buy, it is a call option. If I have a right to sell, it is a put option. A person who buys the right to buy, is called a call holder. A call holder is a person who buys the right to buy. Who sells the right to buy is called as call writer. Sells the right to buy is called call writer. You can also buy a right to sell. Which is called put holder, and sells the right to sell is called put writer. Whenever we evaluate a problem, our analysis is always from the holder's point of view, and then we can change the answer based on whether you are a holder or a writer. There are who can exercise an option? Option will always be exercised by the holder. If an option is exercised, there will be a net settlement. Net settlement will be positive for holder, negative for writer. Holder is a person who can make unlimited profit with limited loss. Writer is a person who will make limited profit with unlimited loss. So we have two types of option, American option and European option. American option is something which can be exercised at any point of time. European option is something which has to be exercised only on the maturity date. What is exercise price? Exercise price or the strike price is the rate at which the contract will get executed. It's also called execution price. Execution is the contract will get executed at this price. There are three types of option: in the money option, at the money option, out the money. The at the money is a very important word because certain question will say it's at the money, and that will help you in understanding what is the price or what is the exercise price. In the money option are those which will get exercised. Out the money are those which will get lapsed. If you say exercise is the answer for something, it is in the money option. If you say lapse, it is out the money. If you are indifferent, it's at the money option. What action do I take in option market? If prices are likely to increase, buy a call option. Prices are likely to decrease, buy a put option. Buy a call option, buy a put option. Call option is useful when prices are going up. Put option is useful when prices are going down. If you want to take more risk, opposite of long call is short put. Opposite of long call is short put if you want to take risk. And opposite of long put is short call. There is something called as intrinsic value and time value. Whichever option, some question will say this is the option price. What is the option prices? That's the premium which you pay. That has two components: intrinsic value and time value. Intrinsic value is the real worth of the option, which can be positive or zero. 0. Time value refers to the difference between the option price and its intrinsic value. Difference between the option price and its intrinsic value. Call option, what is the utility of a call option? Call option is useful for buyers. Put option is useful for sellers. So call option will restrict my maximum purchase price. Put option will give me minimum selling price. So in any problem, you want to buy something and you want to restrict your purchase price, call option is useful. You want to sell something, then put option is useful. Payoff of an option is calculated first by checking whether you are exercising it or not. If you decided to exercise, gross payoff is your income, premium is your expense. If it's the other way party, that is the writer, for him premium is the income, gross payoff is his loss. Gross payoff is his loss, that will give you net payoff. There's a formula for break-even point. I technically don't expect you to remember the break-even price formula. You can put it in the chart itself. But simple formula is strike price plus the premium is the break-even price for a call option and minus premium is the break-even price for a put option. Can you get me answer to this? Read it carefully. I've tried making it little complex and all. So take your time. I want you to give me these answers properly. You want to write GPO of call, GPO of put, total GPO, premium, NPO, whatever way you want to do. But I want the answer to this. Shortcuts and all will not work. Please take your time. I'm giving you time because I know it will take time for you to solve this. What is 38? Okay, let others complete. I've got one answer is 38. I'll wait for another minute and then I start explaining it. But these examples, some of the examples are even more complex than the type of question which comes in ICI material, which comes for 8-10 marks. Ideally, shouldn't take us more than a minute or two to solve this. Will the call option be exercised? Yes, I'll get 40 rupees. Will the put option be exercised? I'm not going to pay anything. How much premium did I pay and how much premium did I receive? 6 paid, 4 received. So net premium is 2 rupees. My profit is 38. Get me the answer to this. I don't want this. This is a break-even price. I don't want this. Break-even I don't want. Give me this. One of the MCQ has a wrong answer. So I don't know which one student had highlighted to me. So anyway, you solve it. Keep asking the right question to you. You will get the answer. What is the strike price? Strike price is how much? 25. What is the stock price? 17. Do you want to buy at 25 when the price in the market is, sorry, call option had 20. Call option is 20. Do you want to buy at 20 when the price in the market is 17? So 0. Do you want to sell at 25 when the price in the market is 17? Yes. 8 into 2. All put together, how much premium we have paid? 20. 2 rupees on call option, 18 rupees on put option. So I make a loss of 4 rupees. Okay. Some question will use the word exercise price prevails on maturity date. There's a wording which is specifically used in a question. called exercise price prevails on maturity date. Now, as such, exercise price cannot change. So, what do they mean by exercise price prevails on maturity date? Is on the last day, actual market price is equal to exercise price. On the last day, if they use the word exercise price prevails on maturity date, they mean on the last day, actual market price is equal to exercise price. Such option, whether it is call or put, will lapse. Be it call option or, because it become at the money. What is the likely value of call option after 3 months? If the exercise price prevails. Exercise price prevails means 0, that's all. Exercise price prevails is 0. I cannot have any value for if the exercise price is prevailing. Exercise, because exercise price does not change. Exercise price does not change. So, exercise price prevails basically mean that on the maturity date, exercise price is equal to actual market price. Now, I come to option valuation. Now, what is the purpose of doing option valuation? Is to find the fair price of the option. Like you find a fair price of a share using multiple approaches of valuation, fair price of a bond using multiple approaches of valuation, fair futures price where we did spot price into e power RT or spot price into 1 plus R the whole power n. So, like that, everything was getting valued by us. We have valued something called as shares, we have valued bonds, we have valued mutual funds, we have valued real estate, we have done portfolio valuation. So, everything is done. Now, we move to option valuation. So, the objective is to find what is the correct premium for an option. Premium is the price of an option. Premium is technically the price of the option. Now, to determine fair price of option, we technically have 5 approaches, but broadly 3 approaches is what will predominantly get discussed. First approach is called put call parity theory, which we don't use it in many questions. Second approach is called risk neutral model, binomial model, Black-Scholes model, and in binomial, replication is a subpart of the binomial. Binomial has a subpart called replication approach. So, these are the methods we have for valuation. Put call parity theory said only one thing. Share plus put is equal to call plus PV of exercise price. Call plus PV of exercise price. For example, exercise price is 90. Okay, exercise price is 90. Share is at 100. Exercise price is 90. Share is at 100. Tell me what is the value of the put option in this? If exercise price is 90 and share is 100. Ask the question, do you want to sell at 90 when the price in the market is 100? 0. Sure. What is the value of the call option? 10. So, I can say 100 plus 0 is equal to 10 plus 90. Present value on the last day will become future value, which is 90. If I change this 90 as 80, if I change, sorry, not 90 as 80, I change it as 120. If the share is 120, tell me the put value, call value. Sorry, I'm changing the exercise price. Exercise price is 120, share continues to be 100. Exercise price is 120, share continues to be 100. This is the situation, okay? This is the situation. Now tell me what is the put value in this example? 20. Call value? So 100 plus 20 is equal to 0 plus 120. This parity should always be there. Practical world, I took the real data and checked. Very small difference was there. The parity is even there in the practical world. Share plus put has to be equal to call plus PV of exercise price. Now, how will this help? In case I have 3 out of the 4 data. I have 3 out of the 4 information. I can use PCPT to do the valuation. A question asks you to value call as well as put. Assume you did valuation of call. Put you can get it through PCPT. PCPT cannot get a value for a call or a put option directly. It cannot be used for valuation directly. It only says that at any point of time, share plus put should be equal to call plus present value of exercise price. In that, share will get replaced with adjusted share price. What is adjusted share price? Share price minus present value of dividend income. Share price minus present value of dividend income plus present value of storage cost can also come, but we don't have all that in the question. We normally don't have. But if gold is an example, then present value of storage cost can get added. So share price or adjusted share price, which is share price minus PV of dividend, or share price divided by the yield, investor, that is dividend yield. If dividend is given in percentage, we divide by e power minus YT r divided by 1 plus y the whole power n. If you remember there, we were subtracting from r. We were subtracting from r. Here the same adjustment is done, but why we adjust it to the spot price? We don't adjust it with the excise price. Earlier ICI in one material had given adjust with excise price. I used to do that, but no, it has to be adjusted only with spot price. Reason is very simple. Share gives you dividend, our share does not give you dividend. Excise price doesn't have any impact of dividend. It doesn't have any impact of dividend. Excise price cannot change just because dividend is paid. So the option, call option, put option cannot give you any dividend. Just because you bought a call option, you cannot tell the company to pay dividend. So share price will fall by the amount of dividend the moment dividend is paid. So share is replaced with adjusted share price. Share is replaced with adjusted share price. What is adjusted share price? Share price minus present value of dividend income, or share price divided by e power yt, e power yt, e power yt. Y is the dividend yield, y is the dividend yield, t is the time period, r you divide by 1 plus r the whole power n. That is if you are going to do normal discounting. Put is either get the actual price or the fair price. If you have the actual, then leave it. Call actual or fair price, and PV of excise price is exercise price discounted at the risk-free rate. Let's see an example. Spot price of share is 100. Let's do this example. Spot price of share is 100. I'm not going to do the problem which is there in the material. I'll do this. CCRFI 12%. CCRFI is continuous compounding. Dividend is how much? I need the present value of this dividend. I need the present value of this dividend, which is 2 divided by e power. 2 divided by e power. When the dividend is going to be paid? 2 months. So e power 0.02. It's 2 divided by 1.0202. E power 0.02 is 1.0202. Tell me the dividend. 1 point. So price is not 100. Price is 98.04. Price is 98.04. Share price will have to be replaced with adjusted share price. You have the life of the option. You have the value of a put. Value of a put, what they mentioned? In the money basically mean exercise price is 100. In the money basically mean exercise price is 100, because our equation is what? Share plus put is equal to call plus PV of exercise price. So I also need the exercise price. I also need the exercise price. So share plus put is equal to call plus PV of exercise price. Share is not 100. Share is 98. Put is 10. Call I'll have to get 100 divided by e power 0.03, 3 months discounting, e power 0.03, e power rt, e power rt or e power. Normally in option I have seen ICI only using continuous. Very rarely you will see normal. There can be problem on normal also, but normally we will use continuous. E power 0.03, which you divide, you get 97.04. You get 97.04. Answer is 11 rupees. The value of the option is 11. When will this approach be useful? If you give me data 3 out of 4. If you give me 3 out of 4 information, I can do share plus put is equal to call plus PV of excise price. Assuming I do not have information, then please get that and then you use the formula. For example, many question will have share, exercise price. Call and put will not be there. So call or put will have to be valued using either risk neutral model or binomial model or the replication model or the Black-Scholes model. You will have to do the valuation and then come back here. You will have to do the valuation and then come back here. Any doubts till this? So very simple approach. In the money. In the money means what? Sorry. In the money I have used the word. Sorry, at the money. The wording is at the money. It should be at the money. It should have been the word at the money. Sorry. It's at the money option. At the money option is both are same. At the money option both are same. Any doubts on this? That's what the question I wanted to create. I don't know why I use the word in the money. It's at the money option. Clear? Okay.
When it is at the money, the put will be 0. Correct with that.
Put will be 0. That is the intrinsic value. Time value will always be there. No, there is a time value and there is a intrinsic value. So today when you do valuation, put will have some value. So at the money option on the last day it is 0, which you are right. Call will also be 0, put will also be 0. That is the last day data. That is the last day data. Today it cannot be 0 because I am taking a risk. No, for the risk I am taking, I need certain returns. Okay. Next comes risk neutral model. Next comes risk neutral model. It is a sub part of binomial model. It is a sub part of binomial model. Very simple model of valuation. Risk neutral model basically says I can do valuation if you give me two prices. If you give me two prices, that is Nifty is today at 21,000. It can either become 25,000 or 23,000, or two numbers you have to give. Two numbers you have to give. If you cannot give me two judgment prices, I cannot use risk neutral, I cannot use binomial, I cannot use replication. You have to go to Black-Scholes model. You'll have to go to Black-Scholes model, which can work even without any kind of assumptions. Under risk neutral model, you have to give me two judgment prices, and expectation is that on the last day only these two prices will be there. No other prices can be there. No other prices can be there. If some other price happens, the model will end up throwing a wrong number. The model will end up throwing a wrong number. So the model can do valuation only if you can confidently tell that price will be 600, 400, 500, 200, any number, but you have to confidently tell only two numbers. Two number does not mean probability is 50-50. Two number does not mean probability is 50-50. How do we get probability? You will understand as we proceed. I'll have to calculate the probability. After calculating the probability, I'll get something called as a weighted average and do the valuation. I'll explain this with an example. This is the formula to calculate probability. I don't do the formula. In case you want to remember the formula, reproduce in exam, that's your wish. I've seen students even without formula writing and they've got marks in exam. So it's your wish whether you want to write the formula or the approach which I'm going to tell. Let's see this. Spot price is 100. Time period of call option 1 year. Risk free rate 10% and bracket normal rate. Normal rate means you cannot use CCRFI. You cannot use CCRFI. Judgment price 75, 125. Without the two judgment price, I cannot even proceed. Without the two judgment price, I cannot even proceed. Excise price is 90. Excise price is 90. First thing we have to do is to find the probability. Let's start with this example itself. Let's start. Working note 1, computation of probability. Computation of probability. Computation of probability. Okay, question has given you spot price, question has given you time period, risk free rate, two judgment prices, excise price. Let me just focus on spot price. What I need to first find is this 100 today by the end of the year will become what? By the end of the year or by the end of the tenor? How do you find fair futures price is equal to spot price into e power RT or spot price into 1 plus R the whole power n? You will have to use your formula of what? Fair futures price. Now write fair futures price spot price into 1 plus R the whole power n. Normal compounding into 1 plus R the whole power n. Dividend, all that adjustment can also come. If they want, they can bring all those adjustment in the question. What's the spot price? Into 1 plus, what's the R? 10% power 1. N is 1 year, okay? So I've done directly 10%. What is the price? 110 should be the price at the end of the year. 110 should be the price at the end of the year. Now I need to find probability for 75 and 125. I need to find probability for 75 and 125. Three columns: price, probability, product, intrinsic value. Again a product. What is intrinsic value? Product. This is another working note. Okay, for the time being leave it. Price, probability, product. Price, probability, product. The two prices I have decided is 75, 125. Your wish, you want to write 125 first, 75 first. That doesn't really matter. The probability of this is A, this is 1 minus A. The probability of this is A, other one is 1 minus A. So multiplied is 75A, 125 minus 125A. Total of this has to be 110. What is total of this 110? Expected price is the weighted average of 75 and 125 with probability being the assigned weight. Expected price is nothing but weighted average of 75 and 125. So total is 75A plus 125 minus 125A equal to 1110. Get me the answer to A. How much? Point? I'll check whether 0.3, 0.7 works. I've substituted 0.3 here. I put a total I'm getting 110. I put a total, I'm getting 110. So the probability of price touching 75 is 0.3 and 125 is 0.7. 125 is 0.7. Any doubts on this? Next, future value of call. Future value of call. Price, intrinsic value, probability product. Price, intrinsic value. Price, intrinsic value, probability product. Price, intrinsic value, probability product. Only two prices. I cannot work any other price here. You cannot tell me that it will be some 10 different prices and all. I can work only with two prices. Price, intrinsic value, probability product. Now what I do here is, what is the strike price? You can write it in the side. Strike price is 90. Call option, okay. This can be used for call. This can be used for put. Probability of 75 was what? 125. Now what the concept is saying is, your price can be 75. If price is 75 on the last day, do you want to buy at 90 when the price in the market is 75? If this happens, I will earn 0 rupees. If this happens, I will earn 0 rupees on the last day. On the last day, I'm doing the calculation of the last day. If this happens, I will earn 0 rupees. Do you want to buy at 90 when the price in the market is 125? How much is the intrinsic value? So indirectly, I'm saying there's a 30% chance of earning 0 and there's a 70% chance of earning 35 weighted average. This is called future value of call. This is technically called future value of call. This is the last day. This is the last day, and this is called, when you do with the price, this is called future share price. This is called future. When you do it for 75 and 125, it's called future share price, and when you do it for 0 and 35, it's called future value of call. That needs to be brought to today by doing discounting. That needs to be brought to today by doing discounting. Wait, this question asks you to value a put. Complete this first call, use PCPT and do put. Use put call parity theory and do put. Or put is only asked. In this question, instead of writing intrinsic value of call, I'll ask you, do you want to sell at 90 when the price in the market is 75? You'll give me 15 and 0 as the answer. I'll do weighted average. That will give me future value of put. That will give me future value of put. You do it this way or you do it in PCPT, final answer will remain same. Final answer is going to remain same. Some up and down rounding of differences will be there, but otherwise the answer is going to remain same. After this, present value of call. Present value of call. 24.5 divided by 1.1. 1 year discounting. Divide by 1.1. 22.27 is the answer. 22.27 is the answer.
110 spot price.
Because all these are future price. Price of 75 is at the end of year 1.
Yeah, same price is going to be 75, 125. Then what is that one?
75 at the end of year 1. 125 at the end of year 1. What is expected return formula? Okay, weighted average of various possible return with probability being the assigned weight. So expected price is 110, which is nothing but weighted average of 75 and 125 with probability being the assigned weight. So price at the end of the year has to be 110. It can be 75. It can be 125. 75 will happen in 3 out of 10 times. 125 will happen 7 out of 10 times. Weighted average is 110. Weighted average is 110. Clear? Any doubts on this? Can we proceed? Everything today, share plus put is equal to call plus PV of exercise price. So if I want share plus put is equal to call plus PV of exercise price, today what is the share price? Put I will have to value, call 22.27, PV of exercise prices, what is the exercise price here? 90 divided by 1.1. 90 divided by 1.1, this will give you an answer. This answer will match if you directly do a put valuation also. If you directly do a put valuation also, it will match. Again, I'm repeating, PCPT can be used if both call and put are asked in a question. If this question I want to value put, very simple here. Do you want to sell at 90 when the price in the market is 75? 15. Do you want to sell at 90 when the price in the market is 125? Future value of put is this much and present value of put is same answer you will get in PCPT. Some up and down rounding of difference can be there. There can be a small amount of rounding of difference, but otherwise, can you tell me 90 divided by 1.1 is how much? Add all this and minus 100. You'll get the same answer. You'll get the same answer whether you do PCPT or you do it through this approach. If only one is to be valued, I can directly do risk neutral. If both have to be valued, because in Black-Scholes they'll ask sometimes both. Black-Scholes one itself takes away a lot of time. So doing the other one will take away huge amount of time for us. So we'll get the answer for one. Second is through PCPT. Second is through PCPT. Any doubts on this? Now I move to the next segment, which is called binomial model. I'll move to the next segment, which is called binomial model. Is this a different model? Nothing much changes here. The only thing is, instead of price change happening once, price change may happen two times. Price change may happen two times. First question be in listen mode. Then you will do one problem along with me. Be in listen mode for the first question. Current price is 20. Share price can either go up by 10% or go down by 10%. The risk-free interest rate is 12%. Using a 2-period binomial means you start with 20. It will go up 22, 18. This is the first period. Another go up, go down. 24.2, 19.8. 24.2, 19.8. One time it goes up, goes down. Again it goes up, goes down. So this is day 0. This is period 1. This is period 2. Period 1 and period 2. You start with 20 rupees. It can go up by 10%. It can go down by 10%. Again, it can go up by 10%, go down by 10%, go up by 10%, go down. What happened?
19.8, 18.
हाँ
19.8.
हाँ ठीक है sorry 19.8 16.2 19.8 and 16.2. These are the different prices which are going to be there. Question has said I need to value the option. If I do risk neutral model, I can only take care of one scenario. Further changes and all risk neutral model cannot take. So I need probability. I need probability to complete the valuation. How will you get probability? Risk neutral model. You'll have to go back to risk neutral model. What is the life of the option here? 6 months. So this is day 0. This is month 3. This is month 6. That 6 months is broken down into 3 months. 6 months is 2-period binomial. You have broken down that into month 3, month 6. So first thing I have to get probability. I have to get probability. For risk neutral, just imagine only this is there. Only this is there. That is price is today 20. It can become 22. It can become 18. Using this, I have to calculate probability. How will I calculate probability? Fair futures price at the end of month 3. At the end of month 3 is equal to spot price into e power rt or into 1 plus r the whole power n. What they have done, let me check if they have done 1 plus r. Okay, they have done 1 plus r. They have done 1 plus r. Using that, you will get the probability, which is 0.65, 0.35. That is price going up is 65%. Price going down is 35%. Let's not worry about the probability calculation. We have already done many questions on probability going up, price going up, price going down. Probability 65 and 35. So every branch, when I was explaining decision tree, I said every branch which comes, I need a probability for that. So this branch is 65. This is 35. 65, 35. 65, 35. Now this is a call option. This is a call option. Now my question is, do you want to you'll have to go in the reverse order. Valuation is always in the reverse order. Do you want to buy at 21? Do you want to buy at 21 when the price in the market is 24.2? So this will have a value of 3 rupees 20 paise. This will have a value of 3 rupees 20 paise. Understand the broad calculation. Next question we will do together. Full problem will do it properly. Do you want to buy at 21 when the price in the market is 19.8? This has 0 value. This also 0. This also 0. If these two are 0, weighted average of that is also 0. Weighted average of that is also 0. For this, the weighted averages, I'll show it a better diagram. 3.2, 0, 0, 0. Okay. Weighted average. 3.2 into 65% is how much? 2 point. I am moving from month 6 to month 3. I'm moving from month 6 to month 3. So I'll have to use discounting. I'll have to use discounting. What is the discounting? Interest rate for 3 months. Interest rate for 3 months. From month 6, I'm moving to month 3. From month 3, we are moving to month 0. So 2.08 divided by 1 plus 3%. What number you get? 2.02. Again weighted average. 2.02 into 65%. 0 into 35% divided by 1.03. Divide by 1.03. Net you get the answer as 1.27. Go through 66, which is an exam question. Go through 66. Consider a 2-year American call option. One thing is, an American option can only be valued under binomial model. Even Black-Scholes cannot value an American option. So in American option, whatever calculation I did, there is one extra check which is needed. What is that extra check? I'll explain. There's one extra check which is needed. Exactly the same approach. First put the diagram. Put the diagram. What is the price today? Strike price is 50. Okay, current price is also 50. Put the diagram first. 50 will go up to what? 60. In fact, same as the number which I had discussed in one of the question. 60 can become what? 72, 48. Okay. Whenever you draw a diagram, please try to write the time also there, because that will help you in doing the discounting properly and probability properly. This is day 0. This 60 and 40 is when? Read the question. At the end of year 1. At the end of year 1. And the next one is year 2. So first focus on this and get the probability. Focus on this and get the probability. Is the CCRFI word used in the question? Is E power value given? Do normal. Do normal. Do normal compounding. Get me the probabilities. There's one extra check needed in an American option. I'll explain that once you are done with the probability part. $50 becomes 53 will be the fair futures price, I think. 53 will be the fair futures price. What are the probabilities you get? 65 and I will not spend time on probability now onwards. If we do a question, I'll copy the probability from the solution and focus on the balance part. 65, 35. One extra check is needed in an American option. I'll explain that. This is called C1, C2, C3. C1, C2 and C3. One extra check is needed. What is that extra check? I'll explain. Coming to year 2. Coming to year 2, reverse order. Coming to year 2. What is the strike price? Do you want to buy at 50 when the price in the market is 72? Okay, 22. Balance will be 0. Any doubts on this? 22, 0, 0, 0. How you normally do is C2 is equal to what? 22 into 0.65, 0 into 0.35, divided by what? 1.06. Give me this number. Don't write this as the answer. This is not the answer. There's one extra check needed. 13 point. Okay, whatever, 50 or 49. Now wait. What is the extra check is an American option can be exercised immediately. Can be exercised immediately or at any time. So assume you want to exercise this at 60. Assume, don't do the weighted average, okay? Don't do the weighted average. Assume you wanted to exercise at 60. Do you want to buy at 50 when the price in the market is 60? You will get 10 rupees. You will get 10 rupees. 10 or 13.5, whichever is higher. 10 or 13.5, whichever is higher. Because in an American option, I do have a choice. There was one problem which if you do at home, you will find. I'll keep doing weighted average, and in the end, the answer will be immediate exercise on day 0 itself. Immediate exercise on day 0 itself. The final answer will be immediate exercise, because you'll have to keep checking this. You'll have to keep checking this. So it is higher of the two number. Higher of the two number. 10 or 13.5, whichever is higher. Which is higher? Listen, other part is very simple. 0. If you do immediate exercise is also 0. If you do immediate exercise is also 0. That is, do you want to buy at 50 when the price in the market is 40? When the price in the market is 40, answer is 0. Again, we'll do a weighted average of the two number and check whether an immediate exercise is needed. Check whether an immediate exercise is needed. Every scenario, you will have to check two numbers. One is weighted average and second is immediate exercise. One is weighted average, second is immediate exercise. Where will this become more useful? In a put option. In a put option, most of the time immediate exercise will happen. Most of the time immediate exercise will happen. When you do at home, there is one problem on put option which is there. I'll show you the problem. See here, immediate exercise will give me 10 rupees. If I wait, it will give me 9.93. You can do this at home, okay? Just understand the calculation. Immediate will give me 10. Later exercise will give me 9.93. I'll do immediate exercise. I'll do immediate. In the end, last day, immediate will give me 20. And all weighted average put together will give me 17.37. Final answer is buy the option and immediately exercise it. Buy the option and immediately exercise it, because that is what was coming in the answer. That is what was coming. If you want, just practice this question at home. 65, which will tell you that immediate exercise will become better. Immediate exercise will become better in few situation. In a call option, few situation immediate can become better. Few situation later can become better. So you see in the solution, I'll keep checking this. Immediate, later, immediate, later, immediate, later. Whichever is better. Whichever is better. I'm not saying immediate will be better or later will be better. But you need to do this extra check. You need to do this extra check for an American option, because American option can be exercised at any point of time. I need not wait for the maturity. Any doubts? Okay. I now proceed to the balance segment. One is a delta hedging concept which I need to discuss. Along with the delta hedging concept, we'll be able to discuss something called as a portfolio replication model. And once that is done, I move to Black-Scholes model of valuation. Now coming to delta hedging, see, I am facing certain risks in my portfolio. One way of hedging it through futures. That is, I go to the futures market, use security beta weight product format, get to know how much futures to be bought, how much futures to be sold, and then do it. Futures was done through beta. Futures was done through beta. Like we have a beta for a futures, we have something called as a delta for a option. We have something called as delta for a option. But delta hedging is not a very good technique. It's not a very good technique. Reason for that is beta of a share does not change much. Delta of an option changes on daily basis. Delta of an option changes on daily basis. What does delta measure is? Delta says what is the absolute, not percentage. It's the absolute change in option premium for change in the value of underlying asset. Absolute change in option premium for change in the value of underlying asset. That is, if the underlying asset is going up, option premium will change. Underlying asset is going down, option premium will change. Call premiums and share price are directly proportional. That is, if share price goes up, your call premium will start going up. For example, I asked you, do you want to buy at 50 when the price in the market is 60, you will say yes, 10 rupees is the price. If price goes up and I say, do you want to buy at 50 when the price in the market is 70, you will say yes and it will become 20. It will become 20. So call option have positive delta. Call options have positive delta. Reason for that is call premium and the share price change will be in the same direction. What is the formula for delta? Change in option price by change in underlying asset. Absolute change, no percentage, no percentage, absolute change, absolute change. So call delta will have positive delta, put delta will have negative. Why negative? Because if call goes up with the increase in price, put goes down with the increase in price, because put wants a decrease in price, put wants a decrease in price, and call wants what? Increase in price. Call option is looking for increase in price, put option is looking for decrease in price. So only thing you need to know is call have positive delta, put have negative delta. What is the formula for delta? Change in option price by change in underlying asset. Change in option price by change in underlying asset. Now there's a formula for put delta. Put delta is equal to call delta minus 1. Put together is not 1, okay? It is residual. Put delta is equal to call delta minus 1. What is the implication of this? If call delta is 0.8, 0.8 minus 1 will be negative 0.2. 0.8 minus 1 will be negative 0.2. And if call delta is 0.5, 0.5 minus 1 will be negative 0.5, negative 0.5. So our call delta is calculated, or put delta, anything can be calculated, okay? The formula is change in option price by change in underlying asset. Example, an investor expects two prices, 180 for TCS, 180 for TCS. The exercise price of the call option is 90. How much is the delta of the put option? How much is the delta of the put option? Let me first do call delta. Let me first do call delta. How will I do call delta? Two prices 180. Two prices are 180. If price is 100, what is the intrinsic value of call option? If price is 100, what is the intrinsic value of call option? And if it's 80, 0. So change in share price is 20, but change in option price is only 10. Change in share price is 20. Change in option price is how much? 10. So my delta is going to be 10 divided by 20. My delta is going to be 10 divided by 20, which is call delta. Put delta, what is the formula I said? Call delta minus 1. So call delta is 0.5. Put delta is 0.5 minus 1. Now what is the utility of the delta? Delta can be used to hedge our portfolio. How do I hedge it? Listen. Like we have security, beta, weight, product. Here we have security delta. Security delta, weight, product. Assume weight is not rupees here. Everything is in number of shares because we measure with absolute change. Rupee means you need percentage change. Here we are working with absolute change. Assume I bought TCS 1000 shares. I bought TCS 1000 share. Now I want to hedge it through delta route. I want to hedge it through delta route. Delta of a share is always 1. Whichever share you do. Delta of a share is always 1. Reason for delta of a share is, delta formula is what is the formula here? Change in option price by change in underlying asset. Why I wanted to show the formula is, what is delta of a share is change in share price divided by change in share price. Change in share price divided by change in share price. That is the underlying asset is the denominator. Underlying asset is the denominator. We are looking at how do you respond to changes in underlying asset. How do you respond to changes in underlying asset? So if you are planning to do TCS hedging, every share separately, you cannot club them together and all. You cannot club a portfolio and do hedging. There you used to do A, B, C together. All that cannot be done. Separate analysis. Separate analysis. I am going to do delta hedging. So TCS has a delta of 1. So 1000 into 1 is 1000. I am going to hedge it through call option. I am going to hedge it through call option. I put a total. Call option has a delta of 0.25. Call option has a delta of 0.25. I want to now hedge it. I want to now hedge it. Okay. Call option will have positive delta. You can also hedge it through put option. You can also hedge it through put option. You can also hedge it through call option, whichever way you want to do. I want to hedge it through call option. 0.25 I have written. My overall delta has to be 0. Overall product has to be 0. No weight and all here. Okay. Overall delta 0. Overall product 0. What is the balancing figure for product? What is this? You should sell 4,000 call option. You should sell 4,000 call option to hedge 1,000 shares. To hedge 1,000 shares. Sell what? 4,000 call option to hedge 1,000 share. I don't want to do it through call option. I want to do it through put option. No problem. Put option has a delta of minus 0.25. Let's assume it has delta of minus 0.25. Balancing figure is plus 4,000. That is buy 1,000 shares of TCS and buy 4,000 put option. Buy 4,000 put option. You have hedged your portfolio. You have hedged your portfolio. The challenge with delta hedging is I do hedging. Next day 0.25 would have become 0.35. 0.25 would have become 0.35 because delta keeps changing on a daily basis. Delta keeps changing on a daily basis. Okay. A frequently tested exam question. There is one logical gap in this question, but it is frequently tested exam question. One logical gap. What is that logical gap? I'll explain. Mr. Dayal is interested in purchasing equity shares of ABC Limited, which are currently selling at 600. He expects price may go up to 780, may go down to 480. Two judgment prices are given. In 3 months, the chances of occurring such variation are what? The problem is with this probability. These are technically wrong probability. If you apply risk neutral model, and calculate probability, you will get 45, 55. You will get the probability as 45 and 55. If you apply 45, 55 as the probability and do risk neutral model, or do replication approach, or do binomial model, all the three will give same answer. But the probability is not 60, 40. The probability is 45 and 55. Because if probabilities are given, what risk neutral model says? Intrinsic value into probability, product, future value of call divided by the discount rate, you'll get the present value of call. That is what we do. But the problem with this is the given probabilities are wrong. It is a frequently tested exam question. It's a frequently tested exam question. So I have been given some probabilities here. I will work with these probability. But if you apply risk neutral model and value the share, you will not get the answer which is there. Any other question, whichever we did till now, risk neutral we are doing. At home, if you try portfolio replication for them, you will get the same answer. Portfolio replication or risk neutral or binomial, all the three will give you the same answer. In fact, there's nothing like all the three model. Binomial has a subset called risk neutral. Binomial has another subset called replication approach. Replication approach uses the concept of delta hedging to do this. Now, what they said is price can become 780, price can become 480. What is the strike price is 630. What I want you to do is please calculate delta of this first. Calculate delta, change in option intrinsic value divided by change in share price. Write in your notebook. Delta is equal to change in intrinsic value divided by change in share price. Change in intrinsic value divided by change in share price. Change in intrinsic value divided by change in share price. Get me the delta. Point 5. That is, if the price touches 780, I will get 150 rupees as the intrinsic value. And if it touches 480, 0, 150 minus 0, 780 minus 480, 0.5. They've asked what combination of share and option you have to create. I can answer this using the table also. By now you should have understood that 1 divided by 0.5 will give the number of option. 1 share and divide by 0.5 will give the number of option. You are not getting the clarity. Security, delta, weight, product. Security, delta, weight, product. Now write a combination of 1 share and writing 2 calls. 1 divided by 0.5. writing two calls will create riskless hedge portfolio. If you are not having clarity on this, security, delta, weight, product. Or combination of buying one call and selling half share will create riskless hedge portfolio. Will create riskless hedge portfolio. We'll normally take buying a share only. We'll normally take buying the share rather than selling the share, because short sell may be difficult in the practical world. Short sell could be difficult in the practical world. So we will go for buying one share and writing two calls. It will create a riskless hedge portfolio. Any doubts till this? Any doubts till this? Okay. Then they're saying, what will be the investor position regardless of the share price? That is, my end result should be same whether price touches 780 or price touches 480. That is called a riskless portfolio. That is called a riskless portfolio. Price touches 780, my value is same. Price touches 480, my value is same. Then only you can call it as a riskless portfolio. Otherwise, it is not a riskless portfolio. Riskless portfolio means, and will it work for any other price? No, only 780, 480. You give me some other price, I cannot do it. I cannot do it because I wanted only two judgment prices. I wanted only two judgment prices. So even my replication approach wants two judgment prices. So let's assume particulars. Price is 780. Price is 780. Price is 480. Price is 780. Price is 480. I bought one share, wrote two call. Okay, I bought one share, wrote two call. So if you exercise the call option, I have a problem with that because my value will go down. I bought one share, wrote two call option. The portfolio one, combination of one share and writing two calls. So first is share, write two call, total value. Share, write two call, total value. Share will give me 780 or 480, whatever is the value. Share will give me 780 or 480, whatever is the value. Share will give me 780 or 480. Two calls. Do you want to buy at 630 when the price in the market is 780? Yes, you will lose 150 rupees. You will lose 150 rupees. Do you want to buy at 630 when the price in the market is what I said, 780? You said yes, you will lose 300 rupees. You will lose 300 rupees. Do you want to buy at 630 when the price in the market is 480? You will not lose anything. I am maintaining identical result. I'm maintaining identical result. I'm not talking about I'm making profit, making loss. I'm only talking about making identical result. That is, you buy one share and write two calls, or you go for buying one call and selling 0.5 share. End result is going to remain same irrespective of price touching 780 or 480, and price cannot be anything else because that's my assumption. That's my assumption. Any doubts on this? Now, how do I do valuation with this? Valuation is very simple. Share minus 2 call. Share minus 2 call is technically a risk-free investment. Share minus 2 call. Why minus 2 call? You said, right, selling. Listen, it's a very simple concept. I earlier have explained in a complex manner in the regular class, but I found out an easy route to get this answer now. Share minus 2 call is equal to risk-free investment. Why risk-free? Because you do not carry any risk. If price is 780, 780 minus 2 into 150, answer is 480. 780 minus 2 into 150, answer is 480. Same 480 which you got, okay? Then 480 minus 2 into 0 is equal to 480. Clear? 780 minus 2 into 150 is equal to 480. 480 minus 2 into 0 is equal to 480. Now I want to put this equation for today. I want to put this equation for today. Same equation which you put it later, I want to put it for today. I want to put it for today. Can you tell me what will be the present value of 480 today? Present 480 is the future value. 480 is the future value. Tell me today's value. Discount by 3 months. Discount by 3 months. $468 point. Same equation. Share minus 2 into call is today 468.29. Share is at today at what rate? 2 call is balancing figure. 2 call is balancing figure and you get the value of the call option. You will get the value of the call option. Now vision. If you apply 45-55 probability, you will get the same answer for call option. You will get the same answer for call option, but you need to apply what probability? 45 and 55. Why? How will 45-55 come? If you apply the risk neutral model formula and calculate the probability. Calculate the probability at home. If probability is not given in this question, you will calculate the probability. When you calculate the probability, I know answer will be 45-55. I have written here 45-55. If you apply 45-55, I'll explain that in a minute. Can you tell me what is the answer for call option? Share minus 2 call is 468.29. How much? 65 point. I repeat again. What we are doing is we are creating a riskless hedge portfolio. What is replication approach? Is creating a riskless hedge portfolio. Now write along with me. Share minus 2 calls is equal to risk-free investment. Share minus 2 calls is equal to risk-free investment. Price is 780. 780 minus 2 into 150 is equal to risk-free investment equal to 480. You should get same answer for both, okay? If you're getting a different answer, then you made a mistake in creating the portfolio. You made a mistake in creating the portfolio. Share minus 2 calls is equal to 480. Next price is 480. Substitute here. We have already done this, but again, I'm doing it so that you get more clarity. Price is 480. 480 minus now what I'm saying is what is today's price? What is today's price? So I'm writing now equation with 600. I'm writing equation now with 600. Only change we are doing in the calculation is when you do with 600, listen, 600 minus 2 into call is not equal to 480, 480 is the future value. 480 divided by 1.025. What's the answer for call option? 65 point. Ignored in this question. This is the frequently tested question. It will be used for some purpose. I'll explain that. 65.87. That is, somebody says I want to follow risk neutral and solve the question. You will not get marks in exam. Okay. Assuming I was following that probability of 45 and 55. Assuming I was following the probability of 45, 55, what you would have done is price would have been 780, 630, intrinsic value is 150, 0, probability is 45, 55, value 67.5, discounted 65.86. 65.86. No model can give different answer. Only problem is if you give wrong probability, I cannot do anything. If you give wrong probability, I cannot do anything. So as such, replication is not even needed because it involves delta, it involves creating a riskless hedge portfolio. It is a slightly longer approach to value the option rather than an easier approach. Easier approach is what? just going by our risk neutral model, just going by our risk neutral model. But in a question, if something like this comes, a same question will come in exam, same question will come in exam, they'll change the numbers alone, they'll change the numbers alone. Please don't follow risk neutral model. Please don't follow risk neutral model. Any doubts on this? Can I proceed? Last line of the question, what is the expected rate of return? Now, right, expected rate of return is equal to, this is where they'll use the probability. This is where they'll use the probability. Expected rate of return is equal to, now they are saying future value of call is equal to 150 into the given probability, into the, don't ask me why we are using and all, 150 into 60%, 0 into 40%. Future value of call is 90. Future value of call is 90. Present value of call is 65.86. NAV1 is 90, NAV0 is 65.86. You will calculate the return. Future value of call is 90. Present value of call is 65.86. Listen for 1 minute. One reason why we cannot use risk neutral model can be this also. If you use risk neutral model, no, you'll get future value of call, discount it, and then you do NAV1 minus NAV0, you will ultimately get the answer as 10% itself directly. Whatever rate you are discounting, that will become the final answer. Then the last part of the question will lose the utility. The last part of the problem will lose the utility because future value you got, you discounted to present value. I'll say future value minus present value divided by present value into 12 by m into 100. Final answer will be whatever discount rate you used. Final answer will be whatever discount rate we use. So that could be one reason for ICI following some other model. For ICI following some other model, it's a frequently tested exam question. I'll repeat replication approach. What we do in replication approach is, first we found out the risk-free investment, which is 480. We found out the risk-free investment, which is 480. We discounted that to today's value, which is 468, and did the valuation 65.86. Did the valuation 65.86. Till now, I have not used the probability. Till now, I have not used the probability. Where am I going to use the probability? I use the probability here. Getting this value of 90. Getting this value of 90. 90 minus 65.86 divided by 65.86 into 100 will give me the return on call option. Will give me the rate of return on NAV1 minus NAV0 divided by NAV0 into 12 by m into 100. NAV1 minus NAV0 divided by NAV0 into 12 by m into 100. Any doubts on this? Any doubts on this? Frequently tested exam question. Frequently tested exam question. If there is a doubt, let me know. You want me to explain anything again, let me know, because before I move to Black-Scholes model, I want full clarity on everything else. Any doubts on this? Okay. Now coming to Black-Scholes model, what we are going to do is, I will take you through calculation for one question. That also I will take you through. You are not going to do anything. You are not going to do anything. Once you understand the calculation for one question, I'll explain the variance. One problem which students face is, the probability values are sometimes not directly given in the question, and they ask you to follow some interpolation. They give some residual probability. All those are useless questions in exam, but I can't help it. Exam sometimes does that. They, instead of giving the right probability, they end up giving you the wrong probability, and you need to work with the probability. For that statistics concepts in finance, there was a material sent in the group. You will go through that to understand three things. One is interpolation, one is probability, and the last one is something called as how to use normal distribution table. How to use normal distribution table. All the three are very critical concepts of finance. All the three are very critical concepts of finance. Ideally, what used to happen is, at final level, there was a paper in costing, there was a sub part called statistics part. The QR part was getting tested. In the QR part, normal distribution was one of the syllabus area. So understanding normal distribution, understanding interpolation is very, very critical from a practical point of view. But I keep using normal distribution. See, what normal distribution can do is, if I know that my average income is 1 lakh and my standard deviation is 10,000, then I can give a probability. What is the probability that my income will be more than 1 lakh 10? What is the probability that my income will be between 90 to 1 lakh 10? What is the probability that my income will be less than 90,000? What is the probability that my income will be less than? All for this, I can give a probability. For all of this, I can give a probability if you understand normal distribution with two numbers. What two numbers? Average and standard deviation. Average and standard deviation. So if I go to stock market, I know the Nifty's average return. I know the standard deviation of Nifty return. How to calculate standard deviation? Return, probability, product deviation, PD square. If I have these two numbers, I can do lot of probability analysis. Lot of probability analysis, provided you have an understanding of normal distribution. If you find some good YouTube video on that, I'm not sure, I've searched, I've not found a very good video, but if you find some video which is related to statistics concept, not related to CA, don't get into a CA related video, because we will not be covering in detail the normal distribution. But an understanding of normal distribution is very, very critical or very useful in a practical world. For problem solving in exam, for Black-Scholes model, some discussion would be needed. Now, what did Black-Scholes model say is, the value of a share is dependent on few parameters. What are the parameters? Spot price, time to expiry, volatility, which is called standard deviation, risk-free rate, and exercise price. These are the 5 variables. So every question I do, and unfortunately, I see exam question, all the 5 are directly given. All the 5 are directly given. So what I did in my batches, in my class batch, I just put the 5 numbers here. I change the spot price 120. The answer will automatically change. Value of call is 25.71. I change standard deviation to 0.5. The value of call automatically changes to 30.63. What ICA expects you to do is this. That is, you do all the calculation, then get to the value of a call or value of a put. But technically speaking, if I write the correct numbers, if I put the correct numbers, automatically the answer will come. Now, before I get into the formula logic and all, let me put the numbers. For example, let's look at one question. Calculation part will come in some time. Okay, I come to question 72. There cannot be, I don't want to use any words. Current share price is 185. So I'll write 185 spot price. I'll write 185 spot price. Next thing they say, option exercise price 170. So they have created the table and given for me. So they have also done the table also. They have given everything. Risk-free rate 7%. Time to expiry 3 years. Standard deviation 0.18. Dividend yield not there. Answer is 51.77. You will take around 20 minutes to get this answer. Answer is 51.77, which is what you will see in the solution. 51.75. 51.75. I'll come to the logic of the formula in some time. I'll come to the logic of the formula in some time. If I want to value put, I can do put valuation using the formula of Black-Scholes, or I do PCPT, same answer, 4.57. 4.57. The rework, this is basically, this in my class material, it was question 90A. There was a rework 90B, there was a 91, 92A, 92B, 92C. I kept on just putting the number, kept on getting the answer, kept on getting the answer. This is what Black-Scholes is all about. Black-Scholes is about 5 variables. 5 variables. What are the 5 variables? You should spot price, exercise price, risk-free rate, time to expiry, standard deviation, and along with dividend yield. Along with dividend yield. Sometimes if dividend is in rupees, for example, this question gave rework a dividend of 2 will be paid at the end of year 1, year 2, year 3. I'll have to adjust the spot price with present value of dividend income. Adjust the spot price with present value of dividend income. I do that adjustment. I got 179.78. I got 179.78 after doing the adjustment. All the adjustment, 2 rupees, 2 rupees, 2 rupees. I did all adjustment. Answer automatically came 47.31, 5.33. You can keep valuing any type of an option using this. The utility of Black-Scholes is any type of option can be valued. You don't need any judgment price. You don't need any judgment price. Obviously, in exam, this calculator will not be available with you. So how do I do the calculation? Now I'll explain the logic of the formula. I'll explain the logic of the formula. Now what formula says is, what is today's price? Option exercise price 185 divided by 170 is today's return for me. The gap between this is today's return. Can you tell me 185 divided by 170 is what? 1.08? Okay, 0889. I can say basically 8.89%. 8.89%. Black-Scholes only follows continuous compounding. So this 8.89% is normal rate. 8.89% is normal rate. Normal can be converted into CCRFI using what? Natural log. So the first part of the formula is natural log 185 by 70. First part of the formula is natural log 185 by 70, which indirectly means today 185 by 170 is 8.89%. Whatever, I'll do the natural log calculation here. 185, just give me a minute. Okay, I have not done the natural log here. I'll show the natural log. 185 by 170. I want to convert this into the natural log value. So today it's basically 8%. Today it's basically 8% continuous, 8.456%. 8.456% continuous compounded higher than the actual rate. Natural log S naught by E. Natural log S naught by E. See, what we are trying to identify is on the last day, how much can the gap between share price and the exercise price can be? How much can the gap be? Today itself there is a gap existing. Today itself a gap exists. What is the gap today? 185 by 170, which if you put it in the form of CCRFI, if you put it in the form of CCRFI, you get a number. Second, every year, share price has to go up at least by 7%. Share price has to go up at least by 7%. So this will lead to extra gap. This will lead to extra gap. How many years is the option? Another 21% gap will get created. Another 21% gap will get created. As the gap expands, the value of the option will go up. As the gap expands between the exercise price and the current market price, the value will keep going up. I'll give you formula everything in some time, but understand the logic. Then going up or going down. See, you said it will go up by 3%, but there is also a standard deviation. There's also a standard deviation, but standard deviation is not the right approach. I should always follow variance approach. I should always follow variance approach. So 0.18 square is what? Point. This is for 1 year. This is for 1 year. How many years we have? So do into 3. 0.9. So first one was some 0.08. Second one is some 0.21. Third one is whatever number you said. Now, statistically, there is a concept which says what is expected return of anybody is today's gap plus the risk-free rate plus half of variance or minus half of variance. Plus half of variance or minus half of variance. That is, you can go up on the half side and down on the half side. That is, your variance can go up. That is, return can go up, return can go down. What is standard deviation? Standard deviation is the variation in the return. Is the variation in the return. So you can go up or you can also go down. You cannot say that you will only go up. That is where the formula of this came. Natural log S naught by E. S naught by E is today's difference plus R into T, future difference. Future difference plus half of variance. Half of variance. What is half of variance? 0.5 sigma square T. 0.5 sigma square T divided by standard deviation. Natural log has a formula. The probability has a formula called x minus x bar by standard deviation. X minus x bar by standard deviation. This is a formula under the concept of normal distribution. Concept of normal distribution. You need not get into much of this. What you can say is today there is a gap existing which is called natural log S naught by E. Tomorrow a future gap will get existed which is called R into T, and there can be up half variance or down half variance. Up half variance or down half variance. Up by half variance, down by half variance divided by standard deviation. What is standard deviation is sigma for 3 years. If you want, sigma into root of 3. You cannot do into 3. Where did we learn this? In risk management. In risk management we learned that you can multiply only with what? Root of T and not with T. So now write formula. D1 equal to today gap plus future gap. D1 equal to today gap plus future gap plus half of variance. That's how you will remember the formula. Today gap plus future gap plus half of variance. Today gap plus future gap. What is gap? X minus x bar. What is gap? Is x minus x bar. So today gap is called natural log S naught by E. Natural log S naught by E. Today's gap. What is future gap? R into the number of years. At least this much you will earn. T can be, see here T has to be only in years, okay? Don't say T will be half year. Everywhere I said R and T can be anyway. Here T, if you do a problem half year, T is 0.5. T is 0.5 only. No saying that I'll do month calculation, I'll do all that, will not work. Everything has to be only in terms of years. R per year, T in terms of years. Plus, what is half of variance is 0.5 sigma square T. Sigma square T is the variance. Sigma square T is the variance. What is the square root of sigma square T? Sigma. This is the formula for D1. This is the formula for D1. Using this D1, I'll have to calculate probability, for which you will need understanding of your normal distribution. I don't want to get into normal distribution because it will take away a lot of time and clarity may not come if I rush through. If I rush through in normal distribution, clarity is not going to come in the calculation of normal distribution. Ideally, what exam question can do is below the table they can give the value. Below the table they can give the value. This is one part. What is D2 is right? Same, today gap plus future gap, but minus half of variance. Minus half of variance divided by standard deviation. Minus half of variance divided by standard deviation. Divided by standard deviation. Today gap plus future gap minus half of variance divided by standard deviation. We will solve this problem also, but I will give you the natural log value directly. I'll give you the D1 value directly. I'll give you the D2 value directly. That is N of D1 and N of D2. I don't want to get into normal distribution analysis. What is today gap? Ln S naught by E. Future gap R into T. Half of variance 0.5 sigma square T divided by sigma root T. One checkpoint for us at this stage is D1 minus the denominator of D1 is equal to D2. That's a checkpoint. Mathematically, D1, you will solve D1 separately, D2 separately. D1 minus the denominator of D1 has to be D2. D1 minus whatever denominator you are using, will be equal to D2. I'm not getting into the derivation of it, but mathematically it has to be equal. Mathematically it has to be equal. Now coming to this question, let's do D1, D2 calculation. Let's do D1, D2 calculation. One question I will do the entire calculation. Balance question, Excel will do the numbers. I'll only explain the concept. In this also, I need one natural log number. I cannot calculate natural log. Question has to give me. I need something called as N of D1 and N of D2. I cannot calculate them. Question has to give me, or I'll use interpolation. These two, if you don't give, for example, in one exam, they did something like this. Natural log, they gave it like this. Natural log, they gave something like this. If you give me natural log, I'm okay. If you cannot give me natural log, I cannot solve the question. D1, D2 probability, they gave something like this and you had to use interpolation. So I am not getting into interpolation part of it. I'm also not getting into something called as normal distribution, because in my regular class, I had to spend 40-50 minutes to explain that concept in detail. So I don't want to get into that part of it. If I find a good YouTube video, I'll share it to you so that you go through it, understand what is normal distribution. It can be used to calculate any probability. Let's come to this question now. Now write in your notebook, D1 is equal to ln S naught by E RT plus half of variance. Very simple formula, you need not remember. Earlier I used to tell people to remember, but now I have got the full logic of it. So full logic is simple. Today's gap, future gap, half of variance. Today gap, future gap, minus half of variance divided by standard deviation. Ln 185 by 170. 185 by 170. I'll give what is this number in a minute, okay? What is 185 by 170 number? I'll give you. R, what is the R? 0.07, only decimal working, please. Don't do percentage, you'll get confused. T, 0.5 was the standard deviation. 0.18 into 0.18 into 3 divided by 0.18 square root of 3, 0.18 square root of 3. Have adequate control on numbers and give me the answer. I can only give you this ln 185 by 170. This number, you will work with 6 decimal. Please work with 6 decimal. 0.084557. Others you calculate. Our final, okay, work with 4 decimal. 4 decimal is fine. 0.0846. 0.0846. Balance, you know, please calculate. First, we need to understand how to calculate D1, how to calculate D2. 0.0846. Whatever you want to add, it's everything is there in front of you. One point 0.0846 plus 0.21 plus what?
0.0486.
04. In D2 this alone will be minus. In D2 this alone will be minus, divided by 0.18 into square root of 3 is how much? After multiplication 0.311. Now after division what you get? 1 point. Any doubts in this? This is called, technically called delta. N of D1, sorry, D1 is not, with this we'll do N of D1, that is called technically called delta. But first complete this. Now, any doubts on 1.1007? D2 same formula, 0.0846, 0.21, but minus. Point. What is this number minus the denominator? D1 minus the denominator. So this will ensure that if you have done any mistake, you will find it. Please don't do, because ICA material says D2 is equal to D1 minus sigma root T. I don't want you to do that. Do both the calculations separately. Very simple formula. What is D1? D1 is equal to today's gap plus future gap plus the half of variance divided by standard deviation. This is technically called X minus X bar by standard deviation. X minus X bar by standard deviation. What is D2? Today's gap, future gap, but minus half of variance. You can go on the upside, you can also go on the downside. You can go on the upside, you can also go on the downside. Clear? Any doubts on this? Any doubts on this? You got these two number. For these two, using certain probability tables, you'll get N of D1 and N of D2 using Z tables. That part of it you can see it later. You can write N of D1 is equal to, write the number, N of D1 0.8645, 0.8645, N of D1, and N of D2 is 0.7889. N of D1 0.8645, N of D2 0.7889. Where will you get this? You will get this from probability table. In Excel I have a formula, norm S distribution. This will give me the value. This will give me the value. How does the probability table look? Just give me a minute. If I have, I'll show it to you. Okay. This is how probability values will be. Positive Z value, negative Z value. Tell me the D1 value. Tell me the D1 value. D1. 1.1 is here. 1.1 is this side. And in the top I find 0.00. So I can find only 2 decimal value. Okay. If you have 4 decimal, you'll have to use interpolation. 1.10 is approximately 0.8643. 1.10 is 0.8643 from the table. What was D2? Give me a 2 decimal number. 0.7. 79 is 0.7852. 0.7852. If you have a two decimal number, I can get the probability. Excel can give me for 4 decimal, 6 decimal, 10 decimal, any number I can do it. But the real values are for 2 decimal. I'm showing you this chart. How will you get for 4 decimal? Get 2 decimal value for 0.79. Get it for 0.80 in between interpolation. In between you have to do interpolation. I don't want to get into interpolation now. That is where I told you statistics, concepts in finance. Please go through that. Please go through those statistics, concepts in finance. Assuming you get your n of d1 and n of d2. What is the n of d1 you got? Point and n of d2. This part I have not explained, but how will you get this is by looking at probability tables. Best thing ICI can do is if they can give D1 and give the probability along with saying that this is the probability, because calculating probability is not my job at that stage. My job is to do the calculation of the option. So that I can do valuation if you give me the tables properly. Any doubts till this? Now, what is the value of a call option? I can only value call using Black-Scholes. I can do a put also, but put has another formula. I don't want to explain two formula. If question asks you put option, do call using this and do PCPT. Do put call parity theory later. Now write the formula. Value of call is equal to listen, I have an option whose exercise price is 100. Call option. Market price is 120. Can you tell me what will be the value of call option? 20. How did you get 20? 120 minus 100. 120 is called S0. So listen, S0 into N of D1 minus exercise price into N of D2. Normally, what is the value of call? S0 minus exercise price. What is N of D1? Technically, probability of option getting exercised. What is N of D2? Probability of option may not get exercised. Something like that. Exactly not that. Listen. S0 is price which should be there in the end of month 3 or today's price. Sorry, S0 is today price. Exercise price is something which you will see at the end of third year. Exercise price. So what they say is do present value of exercise price. To cut it short, the formula is S0 into N of D1, present value of exercise price into N of D2. S0 into N of D1, present value of exercise price into N of D2. Now write the formula S0 into N of D1, PV of exercise price into N of D2. How will you get present value of exercise price? Exercise price divided by E power RT. So they have to give all these numbers in the question. Once this is done, I'll quickly explain it, and then every problem I'll run you through. The every problem. S0 today is 185 into 0.8645. Present value of exercise price, that is if you do discounting, 137.8. 0.7889. I'll explain this again. It may look that it has a lot of calculations. Only problem for me is if they give me natural log value or natural log tables, give me probability value, give me E power value, it becomes very simple. Tell me what's the answer you got. 51 point. Okay, whatever number you get, 51.7. The answer is 51.75, 0.8644, 0.7849. What is the number? Some up and down rounding off will keep happening. Listen, if question asks you to do put valuation, you will do share plus put is equal to call plus PV of exercise price. Now, let me discuss the important items. Okay, listen. First thing, if I'm doing a Black-Scholes valuation, I need only 5 numbers. What are the 5 are technically 6 numbers. Share price, exercise price, rate of interest, volatility or standard deviation, dividend yield, if there's any dividend yield given in the question, if there's a dividend in rupees, also okay, and time period, So once you give me these 6 numbers, I will keep working out the problem. I'll keep working out the problem. Now, what can be the variance which can come in the question? Dividend. Dividend is the one variant which can come in the question. If dividend is in rupees, spot price is equal to adjusted spot price. What is adjusted spot price? Spot price divided by, sorry, spot price minus the present value of dividend. If it is in percentage, again adjusted spot price is equal to spot price divided by e power RT or YT, e power YT. You will have to adjust only the spot price. Once that is done, automatically the formula will keep happening. Okay, listen. I'll quickly close the Black-Scholes model. This can be used to value European option. I've explained it. I first close this and then I come back for the full revision. This can be used to value European option. I need 6 numbers technically: spot price, time to expiry, volatility, risk-free rate, exercise price, and dividend can be there. How do I value? S0 into N of D1 minus PV of exercise price into N of D2. How do you calculate D1? Current gap plus future gap plus half of variance divide by standard deviation. This formula you can change it, okay? Make it as RT minus half of variance. You can just make it as half of variance. It is easy to do it that way. That is what is there, but it's there in brackets. So current gap plus future gap plus half of variance, current gap plus future gap minus half of variance. Now comes certain adjustment. If there is a dividend in rupees, if dividend in rupees means what you can do is you can replace the spot price with adjusted spot price, which is equal to spot price minus present value of dividend. Same thing you can do for dividend yield also. Spot price divided by e power YT. Now there's one very tricky part, but if you get this, it is good. When you do this D1 calculation, what is the formula for D1? Natural log S0 by E plus R into T plus half of variance divided by standard deviation. If you get this, it is okay. Otherwise, whatever I told can work. For D1 calculation, you have 2 choices. Both will give the same D1 only. One is you can use adjusted spot price in the formula. What is adjusted spot price? ln S0 by E. Or you can replace R with R minus Y. Why 2 formula? Because question will give you one ln value. S0 by E value will be given in the question. And you do adjusted S0 by E, that value will not be there in the problem. The last problem we did, the ln value was given. If you do adjusted S0 by E, that value will not be there in the question. That's the only reason. I give you 2 choices. How will you decide what to do? Only seeing what ln value is there in the question. You cannot do both, okay? One option is everywhere else adjusted spot price. When you do your formula S0 into N of D1 minus PV of exercise price into N of D2, all there, please keep using adjusted spot price. For D1 alone, I give you 2 choices. And the 2 choices is only because you do not have the natural log tables with you. So if ICI gives you S0 by E natural log and you do adjusted S0 by E, you will get stuck. So you have 2 choices. You can use S0 by E. If you are using S0 by E, no problem. Just replace R with R minus Y. And if you are using adjusted S0 by E, don't replace R with R minus Y. One of the 2, whichever approach works fine for you, please do it. But how will you decide? Depending on what is the value given in the question. Nowhere else, no other changes. Only for your D1 calculation. And dividend yield in case of fixed life such as patent, gold mine and all, what you do is 1 divided by life. Clear? Any doubts on this? Black-Scholes have discussed extensively. I think this is sufficient. In case you are interested, this is how you will compute N of D1 and N of D2 valuation. But I don't want to get into it as of now because I know it will unnecessarily confuse, because that's what I felt when I did exotic option yesterday, because unnecessarily I add on something extra it becomes a little complicated at some stage. That's why in the video I've removed the exotic option part. Whatever video I've uploaded, I've removed the exotic option part and given you the regular video, because if I try to rush through, whatever you learned will get confused. So that is why I don't want to get into calculation of N of D1 and N of D2. I'll quickly revise what we did now. Only the option valuation part. The other revision is already done. So what we are trying to do is we are trying to find fair price of option. What is fair price of option? Option premium. You are trying to find the option premium. What are the approaches you have? You have a replication approach. You have a PCPT approach. You have a Black-Scholes model. You have a risk neutral model. You also have a binomial model. Technically, there are only two models. Okay, Black-Scholes and binomial. Binomial is broken down into risk neutral and replication. Binomial is broken down into risk neutral and replication. And apart from this, you have PCPT. What PCPT said? Very simple. Share plus put has to be equal to call plus PV of exercise price. Share price will be replaced with adjusted share price, which is nothing but share price minus present value of dividend, or share price divided by e power yt. E power yt. Y is the dividend yield. Y is the dividend yield. Then the second approach is risk neutral model, where give me two judgment prices. Give me two judgment prices. Two judgment prices does not mean 50-50 probability. Does not mean 50-50 probability. What will you do? First, you will calculate fair futures price. How will you calculate? Spot price given in the question into e power rt or into 1 plus r power n. Get that price. Probability for one price is A, another one is 1 minus A. Get upside probability, get downside probability. Now use this probability on the intrinsic value and get the future value, discount it and get the present value. This you can do if you have only one time change. If you have multiple changes, then you go to binomial model. When you go to binomial model, when there are multiple changes, what you need to do is first calculate the probability. After you do your upside and downside probability, you can keep working backwards and then get the value. Weighted average of C1, C2, C3, C4, C5, you can have any number of values. You can keep doing reverse working. We do only two branches. You can have the third branch also. If you have the third branch, weighted average. If there's an American option, you need to check whether immediate exercise is better or later exercise is better. Sometimes immediate exercise may turn out to be better. Whichever is higher needs to be written. In case of American option, value of immediate exercise versus the value of later exercise. Then came the Black-Scholes model. In Black-Scholes model, what we did is I need 5 variables: exercise price, stock price, rate of interest per annum, standard deviation per annum, and something called as your time period, which is in years. What are the variables which can added on? Dividend in rupees, dividend in percentage. Dividend in rupees, remove it from your spot price. Dividend in percentage. See, if dividend in rupees is given, you do not have those two options and all. I gave you two options for D1 calculation. Those two options and all do not exist for dividend in rupees, because I cannot do R minus Y. If dividend in rupees is given, then they have to give appropriate natural log. They'll have to give the right natural log in the question. If there is a dividend in percentage, again adjusted spot price is equal to spot price divided by e power yt. Then comes the formula. D1 is equal to current gap ln S naught by E, future gap R into T, plus half of variance 0.5 sigma square T whole divided by sigma root T, which is nothing but standard deviation. This is D1. What is D2? Minus half of variance. Now when if dividend yield is there, you can do for D1 calculation either replace spot price with adjusted spot price or replace R with R minus Y. This is just because the values given in the question may not be the one which you want. The values given in the question may not be the one which you want, and because of that you need the shortcut approach. What is dividend yield? Given percentage or 1 divided by life. 1 divided by life of the patent. Then extension of this was delta hedging. An extension of delta, that you N of D1 you calculated, no, that's technically called call delta. N of D1 is technically called call delta. An extension of this is delta. Delta C. Portfolio is hedged to arrive at riskless portfolio. You can hedge it through futures which uses beta. or you can use option which uses delta, but the problem with delta is changes frequently. How do you calculate delta? Change in option price by change in underlying asset. As you price changes, delta will keep changing. Calls have positive delta, puts have negative delta. Calls have positive delta, puts have negative delta. Calculate the call delta, then put delta. What you can do is, for example, same formula you can use for put delta, but answer will be negative. Once you call delta is calculated, put delta is equal to call delta minus 1. Both do not add up to 1. What is the use of delta? Security, delta, weight, product. Security, delta, weight, product. That will give you the combination. Simply I can say 1 share and 1 divided by the delta number of calls. 1 divided by delta number of calls. You will have to buy share and sell call. Buy shares and sell call. Once you do that, that is technically called replication. Of a riskless portfolio. So you find out your two prices. See what is the result for the last day. Discount it to today's value. Use the same equation and you will get today's price. After getting today's price, we will compare with the future value of call and calculate expected rate of return. If you give me right probability, risk neutral, binomial, Black-Scholes doesn't work with probability. So ignore the Black-Scholes model. Black-Scholes doesn't work with two prices. It says anything can happen. Practically only Black-Scholes is the right way of valuing the model, because I cannot give two prices and all. So Black-Scholes can handle anything. Can handle any kind of adjustment. Clear? Any doubts on this? I'll again summarize only the Black-Scholes model. D1 is equal to current gap, which is Ln S naught by E. Future gap R into T plus half of variance 0.5 sigma square T. Root of sigma square 2 is sigma root T, which is the denominator. D2 minus half of variance or D1 minus the denominator. With this, I think entire part of derivatives is over. When we did futures, we had 5 approaches or 5 formats. 3 formats I had told you. Apart from that, there was one net realization calculation and one question on maintenance margin. When we did option basics, nothing gets tested. They'll ask you to calculate GPO. How will you do GPO? GPO of call, GPO of put, total GPO minus premium, the final GPO. That is one type of question. And second is option valuation, where predominantly they ask binomial model or risk neutral model. That is working with probability. Clear? We'll end with this then.